we could be on the cusp of a different economic environment where we do need to be a little more careful about inflation.
Americans were flush with cash. They didn't need to borrow, but that wears off.
Some of the strength in the consumer that we're seeing and the credit card spending data, that's going to start to shift to the business sector.
We cannot afford higher rates, and it's very, very unlikely that we will reach the height of the last cycle.
This is going to be a very, very long expansion.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It's Chairman Powell, day 2 from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market pulling back just a little bit on the S&P, advancing on the NASDAQ. Day 2 with Chairman Powell, Tom, and yields are lower. This curve is flatter going into that.
Yeah, the good news for Chairman Powell is Trey Hollingsworth is not going to show up. The gentleman from Indiana, John, as you mentioned earlier this morning, really with a sharp question there on the heart of the matter. What is the Fed doing to the American economy?
Well, let's paraphrase the congressman, Tom. Are we distorting the financial economy for very little benefit in the real economy?
Well, that's the question. Is it a benefit?
The short-term benefits, what are they? What are the long-term benefits of all of this? And to his point, what's the difference between $120 billion of QE, Tom, and 60 or maybe zero? They're the questions we've got to ask at the moment. And when you look at the American economy right now, I think every single data point, can you show me an example of insufficient demand? I can't find an example of insufficient demand in this economy right now. That isn't the issue, Tom.
I can't find it as well. Olivia Rodrigo moving the needle for Giuseppe Zanotti with those shoes yesterday. John, what I would look at is on the Bloomberg terminal, the U.S. 10-year inflation-adjusted yield. It's not in the textbooks. It's nothing Trey Hollingsworth studied at Penn. It's nothing that Chairman Powell's ever seen. Yes, it is a distorted economy.
How did you squeeze Olivia Rodrigo into that answer?
I just had to.
Where did that come from?
Oh, come on. The song is great, John. Just go with it.
Okay, I'm going with it. Lisa, 10s, 132.
You know, to me, the biggest takeaway from yesterday's testimony, and what I'm looking for today with Powell, is his addressing what's the bigger financial risk, allowing markets to run as hot as they are, particularly the housing market, or perhaps basically curtailing this and stymieing the economy. And that really is the tension here, because right now there's no need for them to be supporting the economy more, but they do want to prevent a market's tantrum. And that really is the ultimate question.
Well, the questions that were asked yesterday, I think, are really important. You're jeopardizing your long-term objectives here, which is the question we've been asking repeatedly through the week. Are you risking this cycle being overwhelmed by things that you can prevent? And, Tom, they're the questions that will come up in the Senate a little bit later.
Well, they're going to come up in the Senate. We'll have coverage of that, of course, across all of our Bloomberg platforms. But, John, the answer is the Fed has a plan, and it appears, as Mr. Powell said yesterday, we're going to stick to the plan. I thought the Congresswoman from Missouri, the former ambassador to Luxembourg, her name, I'm sorry, escapes me right now, but she was brilliant about painting out the inflation people are feeling, and yet we have guests, like, say, Jan Hatzius at Goldman Sachs, saying, don't worry about that inflation. Tell that to the constituents.
When you say the Fed has a plan, Tom, the Fed has an established reaction function. They could be overwhelmed by the incoming economic data, and that's the position that some people are taking.
Yeah, right. And Brad, thank you. Ann Wagner from Missouri is the one I mentioned. Yeah, they can be overwhelmed by facts, John. When do those facts come? Maybe not before the next meeting, but as you mentioned yesterday, they don't come in December conveniently. They may come in the autumn.
Let's check in on the price action, Tom. We could be here all day talking about this. 43.64 on the S&P. Equity futures come in about 0.1% on the S&P. Elsewhere on the NASDAQ 100, advancing about 1/3 of 1%, up 48. And Tom's been all over the Apple move over the last week or so. In fact, the last several weeks, the last couple of months, a real rally off the lows on the NASDAQ 100 and some of those big tech names as well. We'll get our teeth into that in just a moment. Outside of that, 132.40, it gets your attention in the bond market. We have a bid. Yields are lower. The curve is flatter. Going into day 2, Lisa, of Chairman Powell's testimony.
And to me, I think that is a really interesting trend. We'll be talking about it throughout the morning. Today, earnings parade continues. Q2 earnings from the banks. Morgan Stanley, the last major U.S. firm to report. I am looking at the sort of toggle between Morgan Stanley and Goldman Sachs, the battle for deal-making prowess. And so far this year, if you take a look at the share performance, Goldman Sachs is up more than 40% versus a 36% gain on Morgan Stanley. Shares a little bit lower in pre-market trading. Expect to expectations very high when it comes to investment banking revenues, profits, and beats. I'm curious how much they will give guidance that this will continue. 8:30 a.m., U.S. initial jobless claims, and we're going to expect the lowest rate of claims going back to the beginning of the pandemic, 350,000. I want clues as to what Fed Chair Jay Powell was saying yesterday, that the 5.9% headline unemployment rate belies this slack in the labor market, this weakness underneath that. Do we get any signs of that from this otherwise very noisy data? And then 9:30 a.m., Chair Powell is going to present day 2 of his testimony, this time to the Senate Banking Committee. John, I want to pick up on what you're talking about, the flattening yield curve. To me, this is the market signaling they are increasingly concerned about a policy error. The Fed is not going to react quickly enough to curtail the inflation that you're seeing again and again with all of these prints coming in way above expectations. If that's the case, the Fed would have to hike faster and then curtail the economic cycle earlier. And that is what's leading to this flatter yield curve, a more negative real yield.
Choking off growth, that's one perspective. Certainly. Lisa, thank you. Bank of England's Mr. Saunders speaking right now. The policymaker from Threadneedle Street. Withdrawing stimulus may be appropriate soon, Tom. He's reflecting on the labour market and the shrinking slag in the British labour market right now. Fact of the matter is, for many people in the UK, Tom, still hard to get a read on where we are in the labour market until we get through the rest of this story, through the rest of this year. And I think many people over on the Fed share that view.
Where are we with the Fed on that? I mean, I don't think we're going to hear it with Jim Bullard, with Michael McKee at 8 a.m. this morning. But John, you really wonder where those voices are, like Saunders, that are going to begin to say to Mr. Powell, let's go. We don't see it yet.
Well, removing the extreme accommodation is one thing, Tom. Positioning for rate hikes is another. And I think the reason that some Fed officials aren't quite keen on the former, even though if it's justified, they're worried that people start to run towards the latter. The sequencing of this is really important. If you start tapering, then you and I are going to have a conversation every day about liftoff. The Fed, or at least some people on the Fed, don't want that to happen.
Well, yeah, but again, it's this word tantrum. We don't want another tantrum. Everyone agrees to that. Is it feasible, with our lack of knowledge, that a central bank can accommodate a society and system without tantrum? John, that is unproven.
Tony Roth joins us now, Wilmington Trust CIO. Tony, I'll start with a simple one. Why yields lower? Why is the curve flatter?
You know, I wish I knew the answer to that question. I think Lisa had a good hypothesis. But I also think that what's important is to be able to see the forest from the trees here on the 10-year and to take a step back from a lot of the gyrations that we've seen recently and be able to predict where is the 10-year going to be, let's say, at Labor Day or at the end of the year. And we believe the 10-year is going to be meaningfully higher as we get through the year. Inflation is going to come down. Inflation is transitory, but it's not binary. It's not you're either in the transitory camp or you're in the camp that inflation is going to run very, very hot. Inflation is going to come down, but it's going to come down to a higher level than where we sat prior to the pandemic. And it's going to come down namely to the level where the Fed wants to see inflation. If you look at inflation expectations, the 5x5s or even the 10-year, inflation is going to come down to probably that 2 and 2.25%, which is not consistent with the 10-year sitting with negative real yields at over 1%. Deficit spending that we're seeing coming from the current administration and Senate caucus, Democratic Senate caucus. Yeah, it's not consistent with the 10-year. Real GDP, tapering, which you guys are talking about, none of that is consistent with the 10-year sitting where it is today. And most importantly, the Fed does not want a zero bound when it comes out of the cycle. The Fed wants to have a bound where it can normalize its toolkit. And so the Fed is going to look to see the 10-year move higher. Tony, so for all these reasons, the 10-year is going to move higher.
We've heard these arguments for a long time, and this is sort of what I'm struck by, that again and again people have pointed to these reasons, and yet again and again we see the 10-year yield go even lower. How do you counteract this argument that basically the high debt load, the fact that potentially the inflation that we're seeing now will stymie growth, is going to lead to a lower growth trajectory that the Fed really can't affect at this point?
Well, I think that, again, the market is driven right now in terms of the 10-year by a lot of institutional trading, a lot of momentum trading, a lot of technical trading. And so there's a fundamental disconnect between real yields and the fundamental economic factors that are going to drive the economy as we move forward. And I think that as investors, as long-term investors, what's important is to focus on when fundamentals will potentially take hold again. And we think that fundamentals will have to take hold as we move into a cycle where the Fed finds it necessary to taper. Whether that is accompanied with a tantrum or not, we'll have to see. But I think it's pretty clear that whether it be the September meeting, whether it be Jackson Hole, the Fed is going to have to frontally address the tapering need. And by the way, ironically, the fact that 10-year yields are so low makes it easier for the Fed to lean into tapering.
Tony, just quickly, where do you want to sit right now in this equity market? NASDAQ had a fantastic run off the March lows. We're up more than 20% since then. Small cap starting to lag. Do you want to lean the other way?
Yeah, I think you do want to lean the other way. I think you want to lean into cyclicals around this notion that the 10-year is going to be moving higher. You want to lean into stocks and into specific companies like PepsiCo that are going to be economically sensitive and that are going to show that they can increase their productivity and that they can pass on pricing to the consumer because of their brand, because of their pricing power, et cetera. And it's not sector by sector, it's company by company. Because you're going to find that there are companies, even in some of the sectors that we don't favor, like consumer staples, just gave you a great example, that are going to do really well in this environment due to their ability to execute and their underlying franchise. And it's going to happen across the entire economy. So overall, we want to be in cyclicals. We don't want to underweight technology. We want to be market weight technology. You don't want to overweight technology, because when you look at metrics like price to revenue, you're at levels that are higher than the tech bubble 20 years ago. So you don't want to be too ambitious with technology right now. You don't want to underweight it, because you can't. You just can't underweight technology, but you need to lean into the cyclical trade.
Tony, good to catch up. Tony Roth of Wilmington Trust, the CIO. Tom, just pricing power just keeps coming up again and again and again. That's where you want to be.
And revenue build.
And consumer price tolerance. All of the above. Coming up in the next hour on That Story, Seb Page of T. Rowe Price from New York City for our audience worldwide. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Federal Reserve Chair Jerome Powell says it's too early to scale back the Fed's aggressive support for the economy. He told the House Financial Services Committee the debate over bond buying will continue at the central bank's upcoming meetings. Meanwhile, Powell said that inflation has risen faster than expected. He's back on Capitol Hill today. Senate Democrats have found a way to help pay for their $3.5 trillion tax and spending legislation. Bloomberg's learned that they want to impose tariffs on carbon-intensive imports. The plan also includes expanding tax credits for renewable energy and electric vehicles. In China, economic growth steadied in the second quarter. GDP expanded 7.9% from a year earlier. That's down from more than 18% in the first quarter, a number that was skewed by the pandemic. Retail spending and industrial output both beat estimates last month. And British Prime Minister Boris Johnson will set out his vision for improving living standards today. Johnson will say that his promise to level up the country is not simply to transfer wealth from richer to poorer parts of Britain. He'll say he wants to improve areas that have felt left behind for decades. And Netflix is making its first big move beyond TV shows and movies. It's planning to expand into video games. Netflix has hired a former top executive at Electronic Arts and Facebook to lead the way. The service will add games to its streaming platform in the next year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta, and this is Bloomberg.
Bipartisan plan. I think we're in good shape. There may be some slight adjustments of the pay for it, and that's going to get down to what the Congress wants to do. I've laid out how I think we pay for it, and we have an agreement.
The President of the United States on an agreement down in Washington. From New York City this morning, good morning, alongside Tom Keene. Lisa Abramowicz, I'm Jonathan Ferro. Thursday morning, and here's the price action. Going into initial jobless claims a little bit later this morning, and some numbers from Morgan Stanley. Thank you for the value add, Tom. 43.56 on the S&P, down about 1/3 of 1%. We are higher on the NASDAQ 100, up 23 points, advancing a little little more than 1/10%. The bond market gets your attention. The bid is back. Yields are lower. The curve is flatter. We're down 2 basis points on 10s to 132.40. And briefly, if you'll indulge me, just quickly, cable, switch on the board.
Please.
Pop on the pound against the US dollar. Cable out by about 0.2%.
Why is that?
To 138.85 because Mr. Saunders over at the Bank of England, Tom, is talking about withdrawing stimulus and perhaps soon.
There it is. And some of the back and forth, I'd say dollar churning here at range bound as well. Right now, we turn our attention to Washington, and always in Washington in the summer, there can be a distraction. Yesterday, the president out with vaccination of the young, and he selected one, Olivia Rodrigo, ex-Disney Plus, and very much now with the #1 hit in the country. It took America by storm. Folks, for you internationally, this has taken the true zeitgeist of America. Miss Rodrigo appearing in a Chanel suit. I believe Anne-Marie Horton has the same suit or something akin to it as well. Anne-Marie Horton joining us from Washington. What's the why on this, Anne-Marie? Why is Washington completely overtaken by events like this?
Well, I think there's just a little bit of excitement. I wouldn't say they're overtaken by events like this,
well
Tom.
Played,
when you have Congress trying to pass through a massive multi-trillion-dollar infrastructure plan, both human and hard. But I will say it does add to a little bit of excitement. Obviously, the Twitter sphere loved it. And I was actually educated by Tom Keene about who Olivia Rodrigo is, and I've gotten into her music the past 48 hours during Balance of Power. Tom just sings during the breaks for me. But actually, in all seriousness, it is about vaccinating the youth, and that was the message of yesterday.
And it's an overlay on this American economy that we've got the 12-year-olds and up, and then we're worried about 5 to 12 years old, I guess, and all that. And the answer is we're making slow progress. Are we seeing the same slow progress in what the president was talking about on his legislation?
Well, when it comes to legislation, there has been like a drip feed of what they do want to get done in terms of how they're going to pay for it. Last night, we heard one thing that could be on the table is the carbon border tax, basically, which means if you have imports into the United States, which are very carbon-intensive industries like steel, aluminum, oil and gas. I'm giving more details of what I think the legislation would look like because it was very slim on details of what this could be. But that's something that's being thrown out. Today is a big day in terms of the Senate to make sure they can shore up how they will pay for all those pay-fors intact for the hard infrastructure deal. But I will say it is moving in the right direction. It's going to be days, weeks, and potentially, as Senator Schumer said, we potentially could be working through the August recess.
And Marie, what you just described sounded like a China tax. Is that how you would characterize it?
Well, China, of course, is one of the biggest emitter. It could be potentially a China tax. Also, Russia, some of these very high carbon countries that have massive exports. This is how I think this kind of legislation or way to pay for this legislation would get bipartisan approval. We have seen talking tough on China, wanting to do more in terms of building United States infrastructure, SIMs here, et cetera, is all about how do we play the domestic game in terms of our foreign policy. And that's what this administration has been doing when it comes to China.
You mentioned China, you mentioned Russia too, so let's talk about Germany. Germany's a country, a government stuck in the middle between the United States and those two issues right now, and often on the wrong side of the conversation. Chancellor Merkel in town. How's that going to go?
Well, China will certainly be top of the agenda. And, John, as you mentioned, they're really stuck in the middle. And it was during the pandemic when China just overtook the top #1 trading partner for Germany. They are just entrenched. I mean, there are more cars being sold in China from Germany than there are in the United States. This is something that we saw a little bit of tension at the G7. The Biden administration really wants Germany in this multilateral approach to combat China. But Merkel is almost 1 foot in, 1 foot out. They want to make sure they can maintain those economic ties when it comes to China, and they're not willing to take as hard of a line. That'll be one of the key things on discussion, and then, of course, Nord Stream 2. This is something that in Washington has bipartisan support to try to put this down, but Secretary of State Tony Blinken said it's a fait accompli. This pipeline will be done at the end of the month. Now it's just about what Germany can do to help secure and support Ukraine, both from a national security perspective, but also economically.
How much will the discussion veer toward the fact that the United States has not opened up the United States to European travelers? President Biden saying he is going to continue the travel ban that we've seen in effect for many months.
I imagine this will be another big topic on the table. I spoke recently to the UK Secretary of Trade, Liz Truss, and she said that her transport secretary, this is their #1 priority. They want to make sure that if you're vaccinated in Europe or the United Kingdom, that you can come over to America. Similarly, as they are opening up in Europe their borders to America. Where this goes, it's going to be very interesting because it seems like the Biden administration is taking a much tougher line, especially with the Delta variant. You also have to think potentially there is going to be a little bit of a hurdle with the fact that AstraZeneca is not a vaccine that's given in the United States, but that is a vaccine that is widely used across Europe. So is the United States going to allow individuals in with vaccines that are FDA approved in the United States, or anyone that is vaccinated with other vaccines? There's others out there, including from Russia, China, et cetera. But AstraZeneca is a huge one for the European market.
Anne-Marie, this was really well navigated down in Washington. Well done. Anne-Marie Hordern, Washington correspondent. Thank you.
Chanel
Tom,
suits
haven't you learned that lesson,
legislation.
Tom? You never comment on anyone's outfit. You just nod. And if you're asked about it, you just nod harder.
I'm loving Anne-Marie's
Just say it looks good.
Are you
Anne-Marie's
kidding?
killing the OOTD.
You don't comment.
Since when has Tom ever followed etiquette, John? Let's be honest.
I'm just trying to give him a little bit of advice, Lisa.
Oh, thank you.
Just to keep him out of trouble, that's
sure
all.
He'll follow it completely.
Although, if you want to make it about business, I saw you were naming some labels there, Tom. Some brands. Chanel. What were the shoes?
Zanatti, we call it.
How'd you know that?
How do I know that? Because Miss Rodrigo is Filipino, so it's a topic of conversation.
There we go. There we go. This is going back home a little bit.
This is going back home
I understand now. Now I understand. Do you get brownie points for mentioning it?
I don't get brownie points for anything. I get some frequent flyer miles when the card gets used.
43.58 on the S&P, Tom. We're down about 10. We're negative 0.2 of 1%.
Yes, we're down about 10.
Chairman Powell coming up a little bit later. Lisa, with yields lower and a curve flatter, your 10-year 132.73.
I'm actually curious to see whether Fed Chair Jay Powell will address the flattening yield curve, this idea that markets are seeing inflation running hotter than expected as potentially forcing their hand and causing them to be more hawkish in the near term. Well, I mean, that's essentially the implication, Tom, from the flattening yield curve at a time when inflation is running hotter than expected.
It's a boom economy. You're talking to me about the pendulum of ominous signals.
100%.
There's ominous signals out there, John.
There are.
Tim Cook's going to be in a conference call. Jesse's going to do his Amazon call.
Senior
ominous
research
signals.
analyst.
World's coming to an end.
Let me just do the tease, Tom, from New York City for our audience worldwide on TV and radio. Tom, you're in a better mood, though. I'll give you that. That's nice. Equities, 43.58 on the S&P.
Look, I can see the Zanatti, the Giuseppe Zanatti store.
Oh, it's a day off tomorrow, isn't it? It's a day off tomorrow.
Look at those markets.
Live from New York City for our audience worldwide. Here's the price action this Thursday morning. Good morning. Equity futures, 43.54 on the S&P 500, coming in about 1/3 of 1%. Your strength over the last couple of months, has been in the NASDAQ 100, advancing another 1/10 of 1% this morning. And look out for the individual components of it. Just a handful of names, the likes of Apple, up by 20-odd percentage points, almost 30% higher. I think about 28 percentage points higher, Tom. Since the March lows, we've had a massive move on that particular stock, and a big move on the NASDAQ as well, coming into this week on an 8 straight week of gains. Switch up the board and get to the bond market. The secret sauce has been here, hasn't it? So what's happening in this bond market? 2s, 10s and 30s shaping up as follows. Your 10-year, 132.40. Yields in again, 2 basis points on 30s. A break of 2% again, 194.41. Down about 3 basis points. And this is what the shape of the curve looks like now. Switch up the board and look at the chart. 2s versus 10s. We just roll over. We just roll over. We were pushing 160 in March, and now we're holding on to 100 basis points. We're down, Tom, to just south of 110. That's setting the tone for this market, for sentiment, and the outlook as well for even things like the financials, specifically the banks, which have had a bit of a toppy time over the last month or so.
And the sum of this is the real yield. One of the statistics that's followed, folks, out to a new large negative low, negative 1.04%. Truly unimaginable within the textbooks and the theory as well. Let's do this right now. Let us turn to Wall Street. And we do this in advance of Morgan Stanley and James Gorman's efforts in asset management, among other things. Devin Ryan joins us with JMP Securities. First gaining my attention, it's Sandler O'Neill, where he won just just about every award you could with securities analysis, particularly with Starmine. Devin Ryan with some great acuity here on financial institutions. Devin, I love what you say in your research note, because I really agree with you that this is a global Wall Street and an American Wall Street in search of the next catalyst. Everybody says it's wealth management. I don't buy it for a minute. What's the next catalyst for these shops?
Yeah, it's the right question. You know, the group has done incredibly well over the last 12 months, you know, kind of as the early days of the pandemic passed and then the market started to rally. You know, financials actually performed very well, you know, mark to market on wealth management, trading was well above normal. You know, investment banking right now is a record. I think, you know, the catalysts are going to have to be company specific. So, you know, we talked about Goldman Sachs quite a bit a couple of days ago with their earnings. You know, they've got a number of new growth initiatives. And I think Morgan Stanley that's reporting today, you know, it is about some of their incremental growth areas, you know, technically within wealth management, but I think, you know, tied to some of the newer areas of focus, like from the E-Trade acquisition, they're really pushing hard into the workplace with, you know, employers, and that's going to be, I think, a big growth initiative. And then the last piece that I think could be a catalyst here is, you know, Morgan Stanley, Goldman Sachs, JP Morgan have all gained a lot of market share over the past 2 years. And so you're going to hear a lot about normalization on, you know, earnings calls over the next week or so. And, you know, trading is normalizing. Investment banking may eventually normalize as well. But the question is, what does it normalize to? And if the bar has moved higher, I think earnings power is stronger than people appreciate. You know, Morgan Stanley's trading market share was 5% in fixed income pre-pandemic. I think it's closer to 10% today, is one example. So I think that's what it's going to have to be. But no doubt the bar is high for these stocks. And that's what, you know, I think we all have to overcome here to get that next leg up, or that next catalyst, as you just mentioned.
Devin, if you compare, say, Goldman Sachs to Morgan Stanley, Goldman are trying to do things organically. Morgan Stanley are doing things by making purchases, some big M&A in the last couple of years. Does that give you a preference on one over the other?
Yeah, so what I would say there is stay tuned on Goldman Sachs. You know, I think let's not count them out on M&A. They haven't done anything big yet, but you know, their stock right now, you're pushing $400. It's a much different calculus than it was not too long ago at $200, you know, and so when you have a much stronger currency, you know, I think that gives you more flexibility to do M&A. They've got a lot of capital that they've built into the system here over the past years. They weren't buying back stock. And then they have, as we were just talking about, a number of growth initiatives, particularly in consumer and wealth and also within asset management. And I would expect that Goldman may be acquisitive, but that's kind of the key thing here. Goldman has so many areas that are newer and starting from a smaller base. And so that's why we are more optimistic on Goldman stock from here over the next, you know, couple of years, because these newer growth initiatives are small but have the potential to all be very significant. I think the consumer and wealth business, for example, over the next 10 years could be you know, a third or more of their overall business.
You alluded to their stronger currency. The stock is up by more than 40% so far this year. There's some strength there, Devin. So talk to me just a little bit more with some specificity about where you think they would be buying specifically. Where's the focus?
Yeah, I think you know, consumer and wealth is one good example. You know, they right now have done some small acquisitions in that space, and you've seen, I think, incremental push to expand the product focus, expand the capabilities on the custody side. You know, the RIA custody side, they're you know, pushing, I think, into that business in a nice way, and there might be opportunities there. But I would say, you know, first and foremost, wealth management and consumer, and then also potentially asset management as well. So those are just a couple examples, but I do think that they are open to it and something to keep an eye on.
Broadening out, it seems like the trend this earnings season has been that those banks that have a bigger component of their earnings from investment banking, from deal making, have done better than those that count more on net interest margins, which have come in disappointing, as well as consumer lending. How long will that continue based on this idea that consumers are flush with cash and that lending, while it's picking up, does not seem to be going toward making profits in the way that Bank of America and Wells Fargo would like to see?
Yeah, I think that trend continues. First off, on investment banking, we have a lot of visibility over the next, call it 9 months here. We're in a record environment right now, right? It was, a record first half. But what's unusual is that this will likely continue. There's been a record amount of M&A announcements. You get paid on M&A on completion, so there's going to be a record level of completions over the next few quarters. But then this whole SPAC wave that came through late last year into the beginning of this year, those are all deals that are still moving towards completion. You get paid primarily on the back end on SPACs as well. So you have this long tail on revenues that's going to push, a very big back half of the year for investment banking. I think probably actually better than people even realize, and then even gives you some momentum into next year. So that, you're right, that has been the trend. I think that continues. Lending, is very competitive, and there hasn't been as much demand. So I think that those are themes that probably don't change here in the very near term.
Devin, to build on that, will the likes of JP Morgan and Bank of America be forced to turn away depositors as they see their balance sheets swell?
I'm not sure they technically turn away depositors, but it is something where deposits are in less demand because every bank is so flush with deposits. So you've already priced deposits down to effectively zero. But are there other things that banks do to deter large influxes of deposits? If you get a market shock, people could bring more money, more cash into banks or into other financial institutions. So I think that it's something that everyone's looking at. But you're 100% right that the value of deposits right now is not what it was, because on the other side, the asset growth isn't quite what people would hope for.
One final question, just to get you in trouble with your general counsel. Are any of these banks brave enough to do the catalyst of acquiring a European bank institution, for example, a beleaguered bank in Zurich? Are any of them brave enough to really do something bold?
Bold is difficult because you're obviously opening Pandora's box of scrutiny. So that's not kind of what we've envisioned for what incremental M&A could look like. I think you can always talk about M&A at the right price. That's a financial deal, but strategically, I'm not sure that would get any of the U.S. banks what they want. So not something that we're expecting. Never say never, but if there's consolidation in Europe, I would suspect it's more European to European versus one of the large money centers in the U.S.
Devin Ryan, good to hear from you, sir. As always, JMP Securities Senior Research Analyst on some of these financials. Tom, be more specific about who you're thinking of. Do they have a $26 billion market cap, perhaps? Is that who you're talking about?
I really don't know. I mean, I just, want to stay clear of that. Of course, we can go to the Bloomberg terminal and find many functions here, and we can look at a book value, John. That would be a book value trading this morning at 0.48 versus JP Morgan 1.9-ish. So I think that's a three-factor.
Can you imagine, Tom, a transatlantic tie-up at this point in any way, shape, or form? I can't either.
Serious, we make jokes about it. We ask the question because it's got to be asked. John, I don't see it. I see them. They learned a lot of lessons 20 and 30 years ago about that train wreck.
Lisa?
I just wonder how much the Archegos debacle actually affected Credit Suisse. Let's put a name to this bank that you're just randomly referring to.
We didn't name a name.
And you're actually seeing not only are they losing business, but they're also losing some top members of their staff to other banks, and that's been coming out. And you do wonder how much they're going to be pressured by this and how they change the strategy.
Everyone's got to do what Larry Fink did of BlackRock. In the last 24 hours, just 8% raises across the board. Now, Tom, speaking of bold, that's pretty bold, just to come out and say, look, I'm going to put my money where my mouth is. I don't think this inflation story is temporary. 8% raises across the board.
Yeah, I think you're going to see a lot of the raises as well. The terminal functions here, like to calculate Credit Suisse, is very important. And John, it's incredibly important to understand our new function, CHAN Go, that can get you to the Chanel website right off the Bloomberg terminal.
Super
it's
helpful,
a value
Tom.
add.
Super helpful. Thank you, Tom. Speaking of husbands that might be in trouble with wives, a Bloomberg Terminal subscriber writes in, can you say happy birthday to my wife, Sue? She's 40 today. Happy birthday, Sue, and thank you for tolerating Ryan and allowing him to watch so much Bloomberg TV and listen to so much Bloomberg Radio. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. The Biden administration is extending a Trump-era halt to economic dialogue with China. Treasury Secretary Janet Yellen's team is in touch with Chinese counterparts, but there are no plans to restart high-level talks. It adds to evidence that President Biden is toughening his stance on China. President Biden has refused to lift rules that prevent most Europeans from traveling to the U.S. European governments are growing increasingly frustrated. They cite inconsistent rules, economic costs, and an outdated strategy for stopping the coronavirus. The travel ban is likely to come up today when the president meets with Germany's Chancellor Angela Merkel. Rural areas in the U.S. with low vaccination rates are driving the most recent COVID surge. The case rate is highest in Arkansas. Meanwhile, in Missouri, infections are at levels not seen since February, and hospital admissions are up 24% in a week. The two states accounted for a tenth of new U.S. infections in the last 7 days. Both have low vaccination rates. And Microsoft CEO Satya Nadella says the company is on the right side of history in antitrust battles. Prosecutors and lawmakers have looked into whether big tech companies abuse user privacy and squash competition. Nadella told Bloomberg TV that Microsoft makes sure user privacy and internet safety are amongst its highest priorities. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
As we move to the fall in the United States in particular, the biggest constraint, other than, frankly, the virus pathway itself, is going to be the question of, can I get people to do the work, and can I get the goods to actually sell? And that's what we hear from our customers they're worried about.
Brian Moynihan there, the Bank of America CEO from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Here's your equity market this Thursday morning on the S&P 500. A slight decline. We're down almost 0.2%, negative 8 points, call it negative 9. Outside of that in the NASDAQ 100 up 38 points, advancing 0.25%. In the bond market, yields are lower, down 2-3 basis points to 131.90. And this big conversation about inflation continues. Larry Fink of BlackRock, we mentioned that a little bit earlier in the program, raising wages 8% across the board below director level at BlackRock, with the following quote: companies are focusing on their employees more, and I do believe you're going to see more wage growth, and that will be above trend line. That's the commentary coming from BlackRock, Tom.
Key thing there, above trend line, John. This is something that's going to be a massive theme into the end of the year. John, would you agree with me that the catalyst for that raise is rent and mortgage payments?
I would agree with all the above and more, Tom.
Yeah.
I think there's some big competition taking place on Wall Street now to really keep people and keep talent.
But the key thing is, John, is it just Wall Street? I mean, are we just going to see this on Wall Street? I don't buy it for a minute. I think it's going to be coast.
I'm with you. I think we're seeing it elsewhere.
Coast to coast. We'll have to watch that very carefully. Right now, as we heard from Mr. Moynihan, things seem good. We can't get product. We hear it in interview after interview. Jennifer Nuzzo's with Johns Hopkins at the dovetail of this medical pandemic with the boom economy. Greg Vallier, in his morning note, says this nation, this country, is red hot. Jennifer Nuzzo, we've got some rising cases, maybe a little bit of rising deaths, some real worry about the variant. Can this variant or that variant derail a red hot American economy?
Sure. I mean, we're seeing case rises in nearly every state, and at least half of states have seen case increases for more than 2 weeks, meaning this is sustained. This isn't just a one-off. So absolutely, yeah. I mean, this remains a national crisis. That said, obviously there's a huge disparity in terms of the states that have high vaccination coverage and those that don't. And that's really the biggest impediment to putting this behind us, is getting people vaccinated.
Okay, we've heard this in every single interview, but what are the pros looking at? The turn in the trend to higher cases, the level of cases, or the rate of change of cases? Which matters?
Well, I look at all of them, and I look at all of them because they each tell me something differently. Obviously, high case numbers are not great because, the more people who get sick, the greater the probability that people are going to wind up in the hospital and die. Now, vaccines help keep that from happening, so it's good that we haven't seen so far a huge surge in hospitalizations and deaths. That said, in the states where the case increases are highest, there are, upticks in hospitalizations, and deaths could follow. So right now, the thing that's keeping that at bay is vaccination, and we need to do more work at that. But anytime we see trends headed in the wrong direction, that makes me nervous, regardless of what the numbers are, because it, foreshadows what could come, and we need to act early because we don't want to have setbacks. We don't want to go back to where we were. Now, I don't think we will. I think, fortunately, vaccines rolled out in, decent quantities will prevent us from going back to what it was like last winter. But we shouldn't be even headed towards multiple week increases when we have tools on hand to prevent that from happening.
Dr. Newt, there was a story that caught my attention yesterday, CDC data that came out that showed that U.S. drug overdose deaths soared almost 30% last year to a record number of people who died from drug overdoses during the pandemic. At what point do we move beyond the pandemic, start to address some of the other health problems that have only gotten worse during this period of lockdown and social isolation, and say, look, COVID is with us. It is going to be like the flu. If you don't get a vaccine, that's on you, and let's move on.
Yeah, I mean, first of all, we should have always been addressing these other health concerns, even at the very start of the pandemic. If you die of an overdose, you die of COVID, that's still not good either way. That said, I mean, one of the differences between now and then is exactly that. We have tools on hand to prevent this from happening. Still, it's really hard, though, if you look at states like Missouri, where they've had sustained case increases, where they're having surges in hospitalizations and they're running out of ventilators. At that point, it becomes a societal problem and not just, an individual choice problem. And that's been the greatest challenge with this virus, is that individual choices affect others. Now, the good news is that if you don't want to be threatened by others, you can go out and get yourself vaccinated, and that helps protect you. But it is still challenging for the country to truly move forward and march towards normalcy when we still have large pockets of the country unvaccinated.
Dr. Newt, so just quickly here, there have been really mixed messages in terms of how well the vaccines that currently are being circulated protect against the Delta variant. What's the latest?
They protect you. I mean, I think we need to keep our eye on the big picture, which is that the vaccines are taming this virus. Sure. Is it possible that if you are fully vaccinated, you could get a mild infection? Could you get a cold? Could you feel lousy for a few days? Yes, it hasn't been happening very frequently, but we know that it happens from time to time. But the good news is the people, that if you get vaccinated, you're not likely going to wind up in the hospital. And the very, very, very rare instances in which fully vaccinated people wind up in the hospital, usually there's some underlying health reason why they're there that makes it harder for them to mount an immune response. And, this is one reason why Israel may be looking to add a third vaccine for people in particular who need really extra help in protecting themselves.
Jennifer Newt, always good to catch up. Thank you. Johns Hopkins Center for Health Security senior scholar. Looking at a number of things, I would say look for three. Look for the relationship between cases and deaths. Of course, that's something people are overwhelmingly focused on. For market participants, for economists, of course, they're focused on two other things as well. The increase in cases, is it changing behavior of consumers? Point one. Point two, are policymakers starting to change as well? On the margin. From Catalonia, Tom, the government more recently talking about a curfew. Just one sign, one data point, and certainly not a broader story just yet, but something worth keeping an eye on. How do consumers respond? Right now, they're looking at getting back to normal. How do governments respond, policymakers? Just some subtle shifts here and there.
The question to me, John, on Catalonia and on Australia as well, just as two examples, is do the individual states do that in America? I can't see it right now.
That's the question I think we've got to ask right here in America, Lisa, for the next several months at least.
I think that the behavior, though, of consumers has been different in different areas. I mean, in Europe, in certain areas, you are seeing consumers do less and go out less when the cases start to go up. So you do start to get a response that's not even relevant to the healthcare professionals. And we did see an increase in inventories that was unexpected in gas over the past week in the United States. So there are signs, John, that perhaps it is affecting mobility.
Just not a broader story just yet, just small data points. Coming up, we'll continue this conversation with Seb Page. Sebastian Page, the T. Rowe Price head of global multi-asset from New York City this morning. Good morning. We're down 13. We're negative a third of 1% on the S&P to 43.54. In the next hour, we'll hear from Morgan Stanley. James Gorman, the CEO. We will hear from his bank and what the numbers are for Q2 earnings. In the FX market, euro dollar 118.22, negative about 0.1% there. And in the bond market, it continues. The bid is back, yields are lower, the curve is flatter, 132.57 on 10s. Hot CPI, hot PPI, a dovish Fed chair, and still yields lower, the curve flatter. From New York City, this is Bloomberg.
We could be on the cusp of a different economic environment where we do need to be a little more careful about inflation.
Americans were flush with cash. They didn't need to borrow, but that wears off.
Some of the strength in the consumer that we're seeing and the credit card spending data, that's going to start to shift to the business sector.
We cannot afford higher rates, and it's very, very unlikely that we will reach the height of the last cycle.
This is going to be a very, very long expansion.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Chairman Powell a couple of hours away from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures down 14 on the S&P. It's a slight decline by a couple of tenths of 1% at 43.54. Once again, though, getting your attention is the bond market. Yields in 2 basis points to about 132, 133. And that line there, Tom, from Steve Major of HSBC, we cannot afford higher rates.
I can't convey, John, enough the difference of opinions on price change right now and how it folds into the interest rate markets. You know, we make fun of Lisa and a pendulum of ominous this and ominous that. You know what? It's a pendulum of opinion right now. Everyone has an opinion.
With very little confidence or conviction.
Exactly.
That's where we are, this inflection point. That's what it feels like, Tom, this tipping point, and we're still trying to work it all out. And I don't think we'll get a clean answer on any of this until the back end of the year.
John,
people keep bringing up September and Q4, Tom, for good reason.
Well, maybe September 2022. I don't know. What I know yesterday, John, is you and I and Lisa got whiplash off of Steve Major of HSBC, full disclosure, a legit pro, saying yields stable, yields lower, and a bunch of CEOs wandering around and, you know, pseudo-economists saying yields higher. I don't know who you want to believe.
Who would you be talking about here, Tom?
I'd be talking to James Bullard at 8 a.m. with Michael McKee.
Looking forward to that interview in about 60 minutes' time. Lisa, we've had hot CPI.
I'm fired up.
We've had hot PPI. I can feel it. We've got a Federal Reserve chairman who's talking the same game, and yet yields are heading the other way.
And perhaps there's a reason that Michael McKee is doing that interview. I just want to cite Mohamed El-Arian. He was talking about exactly this, the hot CPI and hot PPI data that came in. He was speaking in a Bloomberg opinion column that came out about an hour ago, and he said, this goes against the Federal Reserve's often repeated conviction that inflation is transitory, especially now that the base effects have mostly played themselves out. This is a growing idea. And then how do you explain the 10-year? That can only be explained with a Fed reaction function that does eventually have to kick in.
Do you think that's a shift in the reaction function, or do you think that's just a shift in the data? The reason I bring this up, and I think I know where you're going with this, they've got their forecast wrong. That's the belief of some people. That's just the belief of some people. They've set up the reaction function. That probably won't change. But how they respond to the data is established. It's the data that's coming in hotter than maybe they anticipated. And I think they even acknowledge right now, Lisa, that there's upside risk to their forecasts on inflation.
But do they care about the forecasts? This is the interesting thing. Or do they care about the belief that they have made a mistake in tightening too quickly over the past 10 years, and they don't want to make the same mistake? Is that faith going to drive them regardless of what the data shows? I mean, really, the fact that Fed Chair Jay Powell yesterday came out and did not seem seem to have any interest in curtailing bond purchases yet, despite some of the hot data, despite some of the elevated asset prices. Tells you a lot.
Well, he's got a second term to run for, and Tom, let's be clear about that. When you heard from the congressman, the Republican congressman, there were a couple there that said, I think you deserve a second term. This looks done and dusted, doesn't it? Unless the president wants to go his own way.
Well, we'll see. I mean, it's July and it's a silly season on this. It'll develop through the year based on performance and results. John, I got to weigh in here, and then I think there's a balance sheet proposition here. There's a whole idea in economics, folks, of income statement dynamics and balance sheet dynamics. On a stock and flow basis, John, it's real simple. On yield, there's a wall of money that needs to buy something. They are bidding a price which is forcing yield down.
I want to talk more about your pseudo-economist that you catch up with. Still want to know who you're talking about.
Absolutely
I know,
nuts.
But who are you talking about?
I'm not going to go there, John. It just drives me to the beverage of my choice. I want to talk to people that have rammed through undergraduate and graduate level and PhD level microeconomic dynamics. I want to talk to Jan Hatzius. I don't care if they agree. I want to talk to Jan Hatzius. I want to talk to Julia Coronado, and on and on.
I just love that I know who you're talking about. In the equity market, 43.53 in the S&P. We're down 15 and negative about 0.25%. The Nasdaq 100 positive, up about 1/10 on the Nasdaq 100. Out 12 points. Into the bond market, yields lower by a couple of basis points, 132.90. Going into Chairman Powell a little bit later, Lisa.
John, Peter, no, I got to cut in here. This is important. Peter from Chapel Hill emails in and says, put a cork in it.
Okay, thank you for that. Let me tell you what we're expecting today. 7:30 a.m. We're expecting those Morgan Stanley earnings. Very interesting to see how they come in with deal making, what guidance they give, and how they are dealing with some of their acquisitions. Also going to be key is the market share gains that they have been getting from the likes of some Swiss bank, maybe Credit Suisse, in the wake of a number of developments. We've seen that across the board with big U.S. banks. And 8:30 a.m., U.S. initial jobless claims coming out. The expectation is for it to be the lowest level going back to the start of the pandemic. Still 350,000 individuals filing for unemployment benefits. That is the expectation. The key that I'm looking at are signs of slack, are signs of weakness that Jay Powell has been talking about in his testimony. Do we see that in the data, or does it show that ongoing elegant strength, as Tom talks about every time we see this chart? And then 9:30 a.m., Fed Chair Jay Powell returns to Capitol Hill, day 2, speaking to the Senate Banking Committee. I'm curious to see what he says about the flattening yield curve. Does he concede that there are individuals out there concerned about a policy error in them moving too slowly, especially as these inflation data points come in hotter than expected again and again, John?
Sebastian Page joins us now, Lisa. And Lisa, thank you. Joins us from T. Rowe Price, head of global multi-asset. And Seb, I think a lot of people are just confused now on where to be in this equity market, to sit in the index passively or to be active beneath the surface, to lean into small caps, lean out of this rally in the Nasdaq 100. What do you suggest they should do, Seb?
Well, Jonathan, first of all, I feel bad because, to Tom's point, I'm not an economist, but I am an investor. And right now, one of the key questions is really, are stocks in a bubble? I don't think stocks are in a bubble, but they are expensive. They're as expensive as they were at the beginning of the year because earnings have come up. So even though the S&P is up 18%, earnings have come up. You're looking at quarter over quarter of a year over year of 61% with strong quarter over quarter numbers. So the recovery is happening. Now, at this point, we bought 12 billions worth of stocks around the sell-off. We didn't time it perfectly. We bought some before the bottom, some after the bottom, but we've enjoyed the recovery. At this point, we've started selling stocks. And I want to be clear, we're still invested in stocks. We're taking away, say, 1% away from our strategic weights. And here's the key. Why are we doing this at this point? Because stocks have been expensive for a while. It's okay to be overweight stocks when sentiment is negative and you still have room for positive surprises. But what I'm worried about right now is sentiment. We have a composite indicator. We look at VIX. We look at individual investor surveys. We look at speculators. We look at how money managers are positioned. We combine it. That sentiment indicator right now is at the top of its range since we started running it in 2016. So a wise person once told me, a mentor, the secret to happiness in life is to lower your expectations. And right now, expectations are really high. It's a high bar. I mean, we're looking at forecasted earnings of 15, 20% for 2021 above 2019 pre-pandemic levels. So we're dealing with very high expectations and high stock prices.
I want to point out, folks, that the lowly investor has the esteemed finance degree from Sherbrooke, one of the great colleges of Canada, is a CFA, has been published in the Portfolio Journal of Portfolio Management, and has 18 books out as well. Seb Page, don't play it down. And to John's really important point, do you go to an R-squared that is index-like, or are you into individual stock selection?
You know, I think there are opportunities for active management right now, but every time we talk about the debate between active and passive, we tend to look at the average active manager, but really not every active manager is average. So if you have the resources, the long time horizon, and if you do the work, the fundamental bottom-up work, you can add value over indices over long periods of time. And so right now, the dispersion in the market is good. You have a lot of macro trends. So you have opportunities for stock pickers and bond portfolio managers, especially dealing with investments, for example, in emerging markets these days. We're looking at adding value to adding money to emerging markets, value stocks, for example. Tons of opportunities parsing that out, given this unusual environment in the recovery.
Sebastian, just real quick here, what stocks are you selling right now?
So as we get out of stocks, we're tilting towards value. So like a lot of guests on your show, and I'm a fan of your show, like a lot of guests on your show, we're long the recovery trade right now. I think the reopening is happening. So we're selling more growth stocks on the margin, but we're, again, staying invested in growth, just tilting towards value. We also have an overweight towards small cap and overweight towards credit. So we're long the economy, right? We're long this positive macro picture, but where relative valuations make it attractive to be long the economy. And as we're doing that, as we're selling stocks on the margin, then we're buying on the fixed income side some dry powder. We're short duration. We're just talking about the 10-year. So many factors drive the 10-year. So we're short duration. We're adding to cash. We're adding to short-term tips. We're adding to loan, absolute return type fixed income strategies. On the margin, we think that's how to be positioned right now. And would love to talk about the 10-year too, just to say that there are many, many factors. But think about, if we think the 10-year is low, and we're discussing this morning, but if you're a Japanese investor, right now the US 10-year is high. It's high. If you hedge it back to your home currency, it's actually the highest it's been since 2016. So there's a lot of foreign demand. That is one of the factors driving the 10-year lower.
That's a really good final point, Seb. And it's good to catch up with you, sir. Sebastian Page there of T. Rowe Price, head of global multi-asset. The secret to happiness, Tom, lower your expectations. Is that not your takeaway from that, Tom? No? No. Tom Keene, Lisa Abramowicz, Jonathan Ferro. I thought you were fired up.
Triple leverage
lasted like 2 minutes. Coming up, George Sun at BNP Paribas from New York. This is Bloomberg.
With the First Word News, I'm Rich Gupta. Federal Reserve Chair Jerome Powell says it's too early to scale back the Fed's aggressive support for the economy. He told the House Financial Services Committee the debate over bond buying will continue at the central bank's upcoming meetings. Meanwhile, Powell said that inflation has risen faster than expected. He's back on Capitol Hill today. And Senate Democrats have found a way to help pay for their $3.5 trillion tax and spending legislation. Bloomberg's learned that they want to impose tariffs on carbon-intensive imports. The plan also includes expanding tax credits for renewable energy and electric vehicles. In China, economic growth steadied in the second quarter. GDP expanded at 7.9% from a year earlier. That's down from more than 18% in the first quarter, a number that was, of course, skewed by the pandemic. Retail spending and industrial output both beat estimates last month. In South Africa, the number of soldiers deployed to put down riots will go from 5,000 to 25,000. Protests erupted July 10th after former President Jacob Zuma was jailed in connection with a corruption case. At least 72 people have been killed. The uprising is the deadliest since the apartheid ended in 1994. And Netflix making its first big move beyond TV shows and movies is expected to expand into video games. Netflix has hired a former top executive at Electronic Arts and Facebook to lead the way. The service will add games to its streaming platform in the next year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The challenge with this cycle is that everything's happening very quickly. We had a very sharp recession quick. We had a very quick recovery, and we've quickly moved into an expansion phase, and we're already seeing the yield curve flatten. I don't think we're moving into a slowdown in the next couple of quarters. Will we start to move into a slowdown as we move into 2022? Absolutely.
Absolutely. Good to catch up with Brian Levitt there, Invesco Global Market Strategist from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Counting you down to earnings from Morgan Stanley and initial jobless claims in America. 1 hour, 12 minutes away. Going into that, your bond market bid yields are lower by a basis point or two to 133 on 10s. Outside of that, softer, lower. Your equity market, 43.52. We're down 15 and negative a third of 1%. That with the NASDAQ 100 just rolling over a little bit now too. The NASDAQ 100 was positive by a couple of tenths of 1%, Tom, and now it's unchanged on a session.
It is. Watching the markets very carefully and the real yield as well. NASDAQ a little bit green on the screen. Right now we're going to dive into China for too short a time, but the news flow today really extraordinary. George Sun joins BNP Paribas. Head of global markets are great at China, but with the BNP Paribas heritage in China, acute understanding of their gross domestic product, their economic might. George, very simply here, what is the appropriate or minimum level, the politically acceptable level of GDP for the politicians around President Xi?
That's a good question. Good morning, Tom, Lisa, John. I think the stated number they were trying to get for was around 6% or around 6% for the year. Now, keep in mind, it was 18.3% growth in the first quarter due to the pandemic comparison last year. So this quarter coming in at 7.9, it still puts them way on track for the 6% for the year. But what they're really looking at is they're trying to kind of even out the pandemic. So they look at the 2-year average last year and this year. And if you look at that, last quarter on a 2-year rolling average was about 5% growth. And this quarter was 5.5%. So it's getting up there, actually. So I think overall, this was a positive report. And the main reason it was positive is retail sales beat the estimates. Retail sales expanded 12%. The estimate was 10.8. This is good news because up until now in the recovery, it's been very, very slow in the consumer demand side. You know, incomes took a hit during the pandemic and consumers are very reticent to get back in the market. But this June pickup in retail sales shows that it's not just going to be exports or industrial production leading the recovery. Retail sales are going to be there as well. So that's good news.
George, there's been this massive focus on the so-called credit impulse of China right now. Can you just walk our audience through A, what it is, and B, what it tells you at the moment?
Well, I think what China was trying to avoid in this time, they were thinking all the way back to the 2008, 2009 Great Recession. They were trying to avoid asset bubbles this time. They didn't really want to expand the credit markets, credit expansion too much and have asset bubbles all over the place, such as in real estate or infrastructure. You know, a lot of, projects get built for no good reason. So they didn't want that this time. They wanted to keep a tight lid on things. So last year, when the U.S. was doing a lot of fiscal and monetary stimulus, China purposely didn't do a lot of that, actually. They only lowered the interest rate twice, very early in the COVID period, early last year, and they didn't move it again. They didn't move it again for the whole rest of the year or beginning of this year. So, in fact, if anything, they've tightened credits a little bit, actually. So they've put restrictions on the property sector. They've reduced leverage in the property sector. They've tightened the amount of new loans that could be made in the market as well. So I think these kind of strict controls really kept the economy from getting out of control. This is why their inflation rate is actually quite low compared to the U.S., for example. But now it's quite interesting. Now I think what they're feeling is that the recovery is coming. The V-shaped recovery is kind of over. Now we're kind of into the natural expansion. Now they maybe want a little bit of stimulus into the second half of the year because they did something very interesting last Friday. They lowered the bank's reserve requirement ratio by 50 basis points to loosen up the money supply a bit, actually. Now, people were interpreting this sometimes in the wrong way, saying that, wow, maybe the GDP number isn't going to look too good. Maybe this is why they're doing monetary stimulus. But it turned out that wasn't the case at all. They're just being a little bit preemptive.
Well, but this is actually exactly where I was going to go, George, this triple R rate cut. A lot of people looking at this and saying it is very unusual for the People's Bank of China to make just one and done type of move in this capacity, and that there will likely be some sort of follow-on easing. Do you see that as the case? And in other words, basically giving some wind to the bonds in the region and weakening the yuan?
I think there is something to that, Lisa. I think they usually don't do just one triple R cut. They may have another one later in the year. I think they're going to kind of play it by ear and see how the economy recovers in the second half of the year. Another thing that happened today, along with the GDP number, they actually maintained their benchmark 1-year medium-term lending rate. They didn't change it. They left it at 2.95%. So you can't really say they're entering into a very aggressive monetary easing either. They didn't lower their benchmark rate today. So I think they're going to kind of play it by ear and see how this recovery continues, actually.
We are seeing news in Washington, George, son, of a Biden administration, much like the Trump administration on China. How will Beijing react to that?
Well, I think Beijing appreciates the fact that it looks like the Biden administration is going into a lot more details than maybe the previous administration. So they may be against some names that have military connections, but they'll take some names off the list. They'll take Xiaomi off the list. They'll take TikTok off the list because these are not military. And it's very interesting because what happened in the first half as well, China's trade surplus with the U.S. actually expanded. It actually expanded by $165 billion US dollars. So they were trying their best, I think, to honor the phase one trade deal because the imports from the U.S., China imports from the U.S. increased by 56%, but their exports also increased by 42%. So in the end, it looks like they've only accomplished 35% of their quota for the whole year. So they're going to have to pick up the pace in the second half of the year to keep that trade pact at the right level.
George, just a final question from me, and I ask this with a ton of respect for you because I understand how delicate some of these particular topics are, particularly around single names. But Didi's been a big issue here in America. Tapped capital markets stateside, and then got into some regulatory issues in China. I always think it's great to get the perspective of someone within China on the mainland to understand what is going on from the Chinese perspective. What is going on?
Well, I think Didi brings up an issue, but this issue started all the way back last year with Ant Financial, actually, the failed IPO back in November. I think what the Chinese government is really starting to figure out is how do they regulate these big high-tech companies that have become dominant in various sectors. It could be ride-sharing, it could be e-commerce, payments, et cetera. I think, this is a trend around the world. You see the U.S. and EU taking some antitrust actions against Google, against Facebook, et cetera. But I think very quickly, I'll say that Chinese government is looking at it probably at least from three angles. One, cryptocurrencies. You see how China's really been very clear. They've banned both the usage and the mining of cryptocurrencies, and they want to roll out their own e-renminbi currency. So that's a very clear policy. Secondly, for these dominant platforms, these so-called platforms, like the two big ones are Tencent and Alibaba. I think what the government is saying is they're going to start treating them as financial holding companies and regulating them as such. Therefore, you're seeing the valuations drop. So for those two companies, Tencent and Alibaba, since the last 6 to 8 months, their stock prices have dropped by a third. So that's a lot. And then lastly, on Didi, just quickly, George. They control a lot of big data. And this is very, very sensitive. All these areas of big data, anybody that controls now any company that controls over 1 million consumers' big data now, it's going to be controlled by the cyber controls of the Chinese government. So I think that, for example, these 244 Chinese companies that are listed in the US, the ADRs,
George, I've got to run. It's good to catch up, as always. George Sun of BNP Paribas from New York. This is Bloomberg. Live from New York City for our audience worldwide on TV and radio. Good morning to you. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Here's the price action as we await numbers from Morgan Stanley. Equity futures down 0.4%. And here are the numbers from Morgan Stanley. Second quarter net interest income, $1.87 billion. The estimate, $1.77 billion. Net revenue, $14.8 billion. The estimate, $14.03 billion. Important numbers for Morgan Stanley. Wealth management net revenue, $6.1 billion. The estimate, $5.2 2.92. Institutional investment banking revenue, that comes in at 2.38 billion, firmer than the estimate of 2.06. Throwing a ton of numbers at you, I know. Bear with me. Just one final round of numbers. I want to get you the trading numbers. Equity sales and trading revenue, 2.83 billion. The estimate, 2.5 billion. So coming in hotter there, but lighter again. It's another downside surprise when it comes to fixed income sales and trading. How many times have we seen that this week? Revenue, 1.68 billion. The estimate, 1.91 billion. And Tom, the stock, 90.77. We're down by about 1.83% in the pre-market.
This is a company that will have adjustment this quarter. There's lots of moving parts here, and in the beginning of their press release, John, they really do emphasize that E-Trade, Eaton Vance, and on and on. So I think you've really got to be careful here, particularly about single point data points. I'm much more interested in ratios and say return on common equity of 18.6% or 19%, excluding all that Gorman has going on. Those are really not bad ratios, John.
If you'll indulge me, Tom, I think one number that will get people's attention, though, they'll want to see it. Equity sales and trading revenue over at Morgan Stanley is an important figure, 2.83 billion. That comes in hotter than expected. The estimate, 2.5. If we can bring up the stock in the pre-market as we work our way through these numbers, the stock, $90.77. We're down about 1.83%. I want to bring in Sonali Basak, who's leading our coverage of our earnings in the financial sector throughout most of this week. Sonali, just run me through it. You're going through the numbers right now. What jumps out to you?
Yeah, the equities trading number is, of course, very important for Morgan Stanley. Analysts expected that to come in less than Goldman Sachs and JP Morgan this quarter. In fact, they came in more than both of their peers. That miss on fixed income trading, remember, Morgan Stanley brought in close to $3 billion worth of fixed income trading revenue just about a quarter ago. That was unheard of for Morgan Stanley just years ago. Now, $1.6 billion. It's a fine print. It's a solid print. It's more than what James Gorman had been guiding for, but again, less than analysts expected. So what to make of this trading slowdown generally across the street? The other thing Tom had mentioned, that return on equity, it did beat analyst expectations, but the comparative story here is what analysts and investors will also be looking at here, John. That compares to Goldman Sachs' return on equity of almost 24%. So this game of efficiency, this game of market share continues to play on Wall Street.
I noticed down at footnote 12, Mr. Gorman says this note was put together by people sitting in an office. That was a joke, folks. Sonali, E-Trade and Eaton Vance and the rest, are they bolt-ons or are they germane part of the earnings story?
They're germane
a large part of the company.
Huge part of the company, Tom, because we're going to watch Morgan Stanley go through this integration throughout the year. We're going to want to see how that impacts the investment bank. Have they been keeping up the focus at their investment bank while integrating these two businesses? As we know, this M&A market, this ECM market, ultra hot markets in which Morgan Stanley for years has competed neck and neck with Goldman Sachs. Morgan Stanley's market cap has surpassed Goldman Sachs. Its price to book ratio is more rich than Goldman Sachs is trading at right now. So the trade-off is truly staggering as Morgan Stanley's texture of the bank changes.
Well, Sonali, that's exactly where I wanted to go, because I looked at Goldman Sachs shares in pre-market trading just as a comparison. They're also lower by about 0.8%. But the knee-jerk reaction is more for Morgan Stanley, even though, for the most part, these are beats across the board, except for that FIC trading. What do you make of that? Where are people seeing the advantage shifting to Goldman Sachs here?
Well, for now, they're cheaper, right? And that efficiency story is not for nothing, right? We're in an era where inflation on wages is happening across all of Wall Street. Competition is happening. I mean, I twice this week alone, I've spoken to bankers choosing between working at either of these two banks. So that investment bank is no small story, and how they pay those bankers is no small story. Something Morgan Stanley has in its advantage is the tailwinds we're seeing in wealth management. Something John Pruzan talked about last quarter was the idea that it's not just this E-Trade retail frenzy that's feeding activity. It's also the financial advisors across the U.S. that's dealing with their wealthy clients. The lending is higher when it comes to wealthier clients. Morgan Stanley is trying to build that bank when it comes to their wealthier clients. Let's see how much they're able to do that. As we know, their peers are also trying to compete heavily when it comes to high net worth loans.
Sonali Basak, thank you so much. We'll have much more on this. Of course, Allison Williams joining us with a bank sum here in a bit. John, I think we need to pause and just take a moment for James Gorman in his best practices. What Shanali reviewed there is, you know, it passes by in business media as another moment. But, John, these are titanic statements about what Morgan Stanley has accomplished over the last 10 years, even before Mr. Gorman's tenure.
The stock's had a great run year to date as well. And I hate to reduce Mr. Gorman's tenure to what's happened year to date, Tom, but we're up about 35%. I think that's worth noting as you look at a full lower of 1.45%. But there's a difference here, isn't there, between what Morgan Stanley's been doing more recently and what Goldman Sachs hasn't done more recently, and what people expect Goldman Sachs to do, which is to make an acquisition, Tom. We had that conversation in the previous hour.
Yeah, but John, just one anecdote here. There's a set of stairways near a CEO hiding hole at Davos. I stood on that stairway, John, with John Mack after the trading debacle of Morgan Stanley. Let's be direct. They had to go to the Japanese to save the ship. I mean, maybe that's an exaggeration, but we'll go with it for morning TV. John, what Gorman has done is completely underestimated. He went the conservative route with persistency, with his mathematical acuity. And as Shanali mentions, you know, are they cleaning Goldman's clock? No, that's not accurate. But this is true excellence.
And here comes the next act. Tom, and the next act is an expensive one. A lot of investment in a lot of acquisitions, and they've got to work out. Do you think they will?
Well, I have my own opinion, which nobody cares about, but let's be clear here. E-Trade and Eaton Vance are two totally different cultures, and that's going to be an acquisition project of culture as well as finance. Someone who knows that is Amy Wu-Silverman with RBC Capital Markets, joining us for too short a visit this morning. Amy, you look at derivative dynamics right now. What do the four cross moments say about this odd equity market?
Yeah, it's certainly an odd equity market. And to be quite honest, it's giving me a little deja vu because it feels a little bit like August of last year, especially with the leadership, you know, kind of going back to that mega cap tech trend. I will tell you that in the options market, we're starting to see a lot of options volume trading again in these Fangman type names and Apple. And if you look at the playbook to last year, typically that positive momentum just begets more momentum.
August, late August, negative real yields, deeply negative real yields. Amy, that's the parallel here. As you mentioned, do you think that's what's setting the tone more broadly, just what happens in the bond market?
Yeah, definitely. You know, look, that's part of it. And then, you know, the other fact that I think is important is when you look from May to June, a lot of asset managers really missed out when, you know, the NASDAQ heavy names started to outperform again, because obviously they had gotten rid of those mega tech growth, you know, in favor of more cyclical names. And obviously that underperformance means there's going to be a lot of catch up now if these names continue to outperform. And so we'll start to see those skews heavily in the options market.
One reason why it's always fabulous to speak with you is because you understand the positioning and where things are sort of more heavily weighted. We were speaking with Sebastian Page earlier from T. Rowe Price, and he was saying he was lightening up with respect to big tech with some of these growth names. Do you see that more broadly across the board as people reassess after the incredible rally?
Well, you know, it's funny that they had lightened up, and then unfortunately, given the kind of performance, I guess we'll call it a re-rotation, Lisa, in June, people I think are now asking the question, do I need to go back into these names that had been core holdings for so long? And, you know, what's the quickest and dirtiest way to do that? It's through options. So you're starting to see very, very heavy call volume trading, you know, no longer in these meme stocks or these Reddit rally names, but back into these core mega cap tech growth names.
Where does it leave the banks, Amy? Just a final word on that as we work our way through the Morgan Stanley numbers. Where does it leave the banks more broadly?
You know, it's interesting from an options perspective. If you look at these option implied moves on all the financials, they've actually underwhelmed. So meaning, you know, they have these big implied moves coming into their earnings, and then they tend to be smaller actual realized options moves, and they sell off. So we've been pitching, you know, selling calls on these names if we really do get this re-rotation back into the summer.
Amy, always good to hear from you. Amy Wu-Silverman there of RBC Capital Markets. As we work our way through the bank earnings and wrap up bank earnings on Wall Street with Morgan Stanley, their stock is down by about 1.31% after a really tidy, nice rally through the year so far, 2021. JP Morgan nudging lower, down 0.8. Elsewhere, Goldman down about 0.8% as well. Equities trading revenue coming in a little bit hotter at 2.83 billion, the estimate 2.5. But once again, Tom, it's been a struggle to get a read on fixed income trading, that's for sure. The analyst community have certainly struggled. 1.68 billion, the number, the estimate 1.91 billion. Just a very small downside surprise, but there's a trend there for sure through much of this week.
I learned that from Brad Hintz at Sanford Bernstein and the wonderful David Barry at Keefe Bruyette and Woods ages ago. You know, you get quarters that are a mess where you can't figure out what's going on, John. I think there's too much acuity, too much over-analysis of quarter-to-quarter statistics on securities firms. These are beasts that go with the market and go with the economy, and sometimes things aren't clear. That's okay.
The beast needs to get paid. That's a theme we need to talk about as well, Tom. Wages, labour costs, these aren't the conversations we spent the last 10 years having.
It's a huge deal between the partition of salary and bonus and a reality of living costs. And for those worldwide, I'm sensing, John, a titanic shift in the major cities towards we got to pay people so they can live.
Talent retention, a huge issue. A conversation with Jim Bullard coming up a little bit later. James Bullard, the St. Louis Fed president, with Michael McKee. That conversation 20 minutes away, right here on Bloomberg Surveillance, live on TV and radio, with your equity market 43.51 on the S&P, a downdraft of 17 points. We're down 0.4%. In the bond market, yields lower by 2 basis points lower to 132.57. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The Biden administration is extending a Trump-era halt to economic dialogue with China. Treasury Secretary Janet Yellen's team is in touch with Chinese counterparts, but there are no plans to restart those high-level talks. It adds to that evidence that President Biden is toughening his stance on China. And President Biden has refused to lift travel rules that prevent most Europeans from traveling to the U.S. European governments are growing increasingly frustrated. They cite the inconsistent rules, economic costs, and an outdated strategy for stopping the coronavirus. The travel ban is likely to come up today when the president meets with Germany's Chancellor Angela Merkel. And South Korea seeks to move up its own spot in the global space race. The country's science minister says this means launching satellites on homegrown rockets and eventually a mission to the moon.
The reason for moon exploration is because we expect it to be utilized in the future for not only national defense and the public sector, but the economic sector as well. In that sense, we believe we have to actively take part in the Artemis program in order for such cooperation to take place smoothly.
South Korea saw limits removed on its rocket development earlier this year when the U.S. lifted restrictions in a bilateral agreement. And Blackstone is buying $7.3 billion of housing and insurance assets from insurer American International Group. The private equity giant also agreed to manage $50 billion from AIG's life and retirement portfolio. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
In our commercial banking business, we're continuing to see those loans decline because clients have a lot of liquidity. There's supply chain issues. There's huge demand. They're not needing to build inventories right now, or not able to build inventories right now. And so we haven't quite seen the inflection point there yet. But I think people are hopeful that at some point over the coming quarters, we will.
That was Michael Santamassimo there, the Wells Fargo CFO from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Morgan Stanley numbers behind us. Your equity market taking a little dip lower. We're down 1/3% on the S&P, negative 13. Yields come in a couple of basis points on a 10-year to 132.57. That's the broader market. Here's the stock to watch. Morgan Stanley down by 1.59%. Once again, another bank coming in a little bit lighter than expected on fixed income trading revenue. 1.7 billion the number, expectations 1.9. Here's the quote. Fixed income underwriting revenues decreased from a year ago, primarily due to lower investment grade and non-investment grade bond issuances. Tom, we're down by 1.6%.
They've cratered. They've crushed, John. What are they up in the last, 3 years? 400%?
They're up, I think, 30-odd percentage points year to date, Tom.
They're
doing okay.
They're doing okay. Right now with a summary of what we've seen, Allison Williams, Bloomberg Intelligence. And Allison, what I think is so important here is the view out. We're focused on the minutia right now. Where are these institutions on July 15th, 2026?
They're in great shape.
and it's really a solid quarter. So we have seen most of the stocks trade off. But, you know, it's about expectations, and, you know, 1% after a huge move is not something that I would get overly upset about. You know, we look at Morgan Stanley's results today, and we see strength across the board. The one weak spot and the one thing people might be a little bit worried about is the equities trading line.
That's just a terrible. I guess gray hair is just flowing in her. Allison, just because of time, I want to get to it because I know John and Lisa have some important questions. James Dimon a couple years ago said, look, all we do is hard work. What is the hard work for the American banks to succeed internationally?
I think the hard work is really the investments, right? So on the ground, building the business. These banks, you know, there's a difference between buying and building, and JP Morgan is doing a little bit of both. And to your point, going international is something that's new for them on the retail. They're obviously a huge global bank. On the institutional side of things, they bought this little business in the UK, and I think we're going to see that built out over the next couple of years. And it is, I think he said something like blood, spit, and gravel in one of his recent talks at the conferences.
That's Shakespearean, John.
Blood, spit, and what was it? Gravel?
Yeah.
Nice.
That's a slogan for the
You're getting paid extra for blood, spit, and gravel.
Yeah.
Over at Morgan Stanley, Tom.
I guess so.
It's the war on technology, you know. So we know that the banks have money and they're spending it. It's hard to see what the return on investment is today. But I think that's where they're doing the tough work.
Allison, how important is it that Morgan Stanley showed an increase in interest income and lending, sort of contrary to what we saw at other banks?
So I think that's a positive, but for them, it's perhaps a smaller part of the business. It is part of their wealth business, which is overall a big unit. But I think that what investors might be looking at is the equity trading line. We know that they're the biggest in equity trading. All the banks beat. Morgan Stanley beat, but perhaps a little bit higher bar coming into the earnings. And sort of the 8% growth looks a little bit modest compared to peers. And the question may be, after last quarter, what we saw with Archegos, are there some changes that are making an impact? They did say in their statement that prime brokerage was a help. We know that JP Morgan and Goldman had record prime balances. Bank of America and Citigroup, we think, are gaining share. They had really strong growth, although a little bit easier comparisons. And so that's, I think, really the one thing that investors may complain about. Otherwise, flows looking really good. Some slowdown from the last quarter, but that should be expected.
Allison, when you take a step back, the big 5 U.S. banks have reported already, and we have been talking about taking market share, as you talked about, from the likes of, say, that Zurich bank that Jefferies actually just warns may disappoint after the talent drain. How much have the U.S. banks gained share? I mean, which banks are the main gainers?
I think that has been the story of the last decade, and the biggest beneficiaries have been Morgan Stanley, Goldman Sachs, and JP Morgan. And in fact, equities trading has been a key area for the banks, but also fixed income trading. And Morgan Stanley, even though we talk about equities, they've been one of the biggest gainers there over time. And so these three, the leaders, have actually been consolidating share, especially within the cash equities business. Prime brokerage is a business where, again, the banks were beneficiaries when Deutsche Bank did their step back a few years ago. In the current environment, again, Credit Suisse making a more dramatic pullback. They've specifically said they're going to be cutting their balance sheet there. And so we think that the banks are benefiting not just in prime brokerage, but through sort of knock-on risks, as we call them. Cash equities, again, is an area we think they're going to be gaining. Bank of America and Citigroup have also gained, but we think that this is now really the opportunity for them because the other three are already so big in prime brokerage.
Citigroup lifted base salaries to $100,000 for first-year analysts that don't know 1/10 of what Allison Williams knows. Another sentence, BlackRock to lift compensation 8%. Oh, it's terrible. Come on, this is a rounding error for their income statement, isn't it?
It's a very small impact, but I think you are hitting on, I think, the big thing that we're going to be focusing on coming out of this quarter, and that is the cost line. I think that's really what investors have been reacting to. We've had JP Morgan has guided up about $5 billion since early December in $1 billion increments. Citigroup is up upping their guidance, which they set as investments. We view that more positively than these sort of transformation costs. As we said, banks need to invest for the long term, sort of ignore the short-term noise. But the question is,
lifting pay 6-8% for young Turks is going to affect their core ratios.
So not that specifically, but I think overall. The banks are spending more. And we do wonder, so two things. We have higher costs across the banks. How much of that is inflation? How much of it is the cost to compete? So in terms of compensation, because the banks don't just compete with each other. They're competing with hedge funds. They're competing with tech firms.
No.
And then secondly, so it's the cost to compete. And then, in businesses like credit card, is it going to cost them more?
They're just going to go spend the money at Chanel, right, Lisa?
You know about Chanel better than I do, Tom.
That was a good comeback.
This morning.
Thank you.
It's
true. Leave that there. Alison, it's good to catch up. Alison Williams, Bloomberg Intelligence Senior US Banks Analyst. Tom, I know outside the banking industry there will be the smallest of violins. For people working in the banking industry, there has been this feeling now for a while. These banks have been delivering record profits. You've seen the buybacks for investors. For people working within the bank, they felt like they haven't had a big enough share of that. And you can get a feel of that almost instantly. And they've been banging a drum on this for a while, that needs to change. And here we are, talent retention, the battle for talent. And I think Lisa has touched on something really, really important. Can the Europeans really play that game? Can they play the game the American banks are about to start playing?
I don't know. What I know for certain is it's not just the banking industry, John. It's going to be other industry sectors as well. You're going to see it in tech and all of them. I mean, pay the kids.
I know where your wages are going now. That's for sure.
How many kids?
Lisa Abramowicz.
Yeah, exactly.
Jonathan Ferro.
You be good.
Where's that suit from, Tom?
This?
Yeah.
It's the store just down from McDonald's on 3rd Avenue.
Yields in 2 basis points. 132.57. Jim Bullard of the Fed coming up next. Looking forward to that. This is Bloomberg.
You still have room for positive surprises. But what I'm worried about right now is sentiment.
Some of the strength in the consumer that we're seeing and the credit card spending data, that's going to start to shift to the business sector.
We cannot afford higher rates, and it's very, very unlikely that we will reach the height of the last cycle.
This is going to be a very, very long expansion.
It's pretty clear that whether it be the September meeting, whether it be Jackson Hole, the Fed is going to have to frontally address the tapering need.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. A very important Thursday, as always, on radio, on television, Bloomberg Surveillance. John Ferro, we've got 14 things to talk about. Let's squeeze it in now before Michael McKee and James Bullard of the St. Louis Fed. They're looking at a bond market most unusual.
Yield to lower, the curve's flatter. That's curious, isn't it, in the face of hotter CPI, hotter PPI than expected. A lot of questions still to be asked from this Federal Reserve, Tom. We understand the objectives. We understand the mission. We need a better understanding of how $120 billion of asset purchases every single month helps them achieve that. And in the words of Congressman Trey Hollingsworth in the last 24 hours, Tom, are we distorting the financial economy for very little benefit in the real economy? That seems to be a big debate that gets a lot of attention still.
And John, what's so important here, and we lead strong in this morning on Bloomberg Radio and Bloomberg Television, are Michael McKee with James Bullard. Then later he will be in conversation at the Rocky Mountain Summit with Charles Evans of Chicago. And I believe, John, Chairman Powell will stop by as well for an appearance midday.
Mike McKee's got it right, hasn't he, Tom? He's got it right. Maybe that's what we should be doing. Chairman Powell will come by in the next couple of hours. We'll get a testimony from him, and then we'll have some questions, this time from the Senate Banking Committee, Tom. And I imagine it'll be more of the same for a Federal Reserve chairman looking for a second term. Let's be clear about that. That very much on the agenda.
Raging debate, Lisa Abramowicz, the nuances, the distinctions of transitory and temporary. Which is it?
And one of the most important aspects, I think, of the testimony yesterday, and frankly, what he might say today, is Fed Chair Jay Powell's comments on housing. tapering. And frankly, the line of questioning there, when you talk about the elevated asset prices and the potential for financial market distortions to have a real-world impact, that's very much the forefront of his focus. And I'm curious what Jim Bullard says about tapering mortgage-backed securities purchases.
Well, that's economics of the moment. John, all of it wrapped around a morning of data and, of course, claims coming up as well here in 28 minutes. Red and green on the screen has become red on the screen. Futures negative 15. John, out of stick in the VIX, not a big deal. 17.53 is in gloom, but it's not the day after day bull market we've seen.
Let's keep it brief, Tom. Bit into the bond market. Yields
Yes.
lower, curve flatter. We're down 2 basis points to 132.57. And if you're just tuning in for our audience worldwide on TV and radio, Morgan Stanley down about 1.36%. Just a little lighter on fixed income trading once again. Forget James Gorman's bank on Wall Street, Tom.
Very good. It is a regime change. Well, no, actually, nothing's changed. Michael McKee is off at someplace romantic, while Lisa, John, and I are in the cold chill of a summer in New York. It is Michael McKee in conversation at the Rocky Mountain Summit with the most interesting gentleman from St. Louis. Michael McKee, good morning.
Good morning to you, Tom. We are here in Victor, Idaho, where the sun will be up in a little bit. The sun's already up in St. Louis, and we'd like to welcome Jim Bullard to Bloomberg Television and Radio Worldwide. Good morning to you, sir. I'd like to start with a two-part question. Chairman Powell yesterday said that inflation is largely a factor. The inflation we're seeing is largely a factor of the reopening of the economy and supply chain issues that will fade. But he also said that we are some ways off from the substantial further progress the Fed's using as a marker for when it wants to start tapering. So question one, do you agree with Chairman Powell on inflation that it is going to be very temporary? And question two, where do you think we are on that substantial further progress continuum?
You know, you said very temporary. I think that's the key debate here. I think it's clear that some of the inflation will be temporary. How much and how much feeds into a more persistent process is really the question that the committee has to wrestle with going forward here. So I think we're already above our target on core PC inflation. The committee, according to the summary of economic projections, is projecting 3%. That's excluding food and energy prices. That's more inflation than we've seen in a long time in the U.S. And I think some of that will hang on and persist through 2022. And we had hotter reports than we anticipated recently. So there's some possibility that we would ratchet up our expectations for inflation in 2021 and 22. So this is a different situation than we faced in the past. On the labor market, I think we have made substantial progress. We've come a long way from where we were last December. And all indications are, by anecdotal reports, that the labor market is going to continue to improve. A lot of people are looking toward September, October, when schools are back in session, for further improvements. So I think we're in great shape on labor markets as far as having been able to make progress since last December. It's not fully healed. It's not fully done. But have we come a long way since December? I think the answer is yes.
Well, in terms of that progress, then, do you think tapering may have to come sooner than most people anticipate, perhaps pulling it forward into the fourth quarter of this year?
Well, the committee's going to debate that in earnest now at the July meeting. I would emphasize there are lots of parameters around a taper decision. The starting date is only one part of it. The pace of tapering is another part. MBS versus Treasuries, and we can talk about that if you want. But I think the most important thing, and that I've been stressing here, is the idea that you probably don't want to be on automatic pilot in this situation. This is a really fast-growing economy, lots of things happening both in the U.S. and globally. And I don't think we have the luxury of being able to just go on to automatic pilot and say that we're never going to change the pace of purchases. I think we have to be more state contingent than that. Because we're not quite sure where this inflation process is going to go. We need some optionality on the upside with respect to possible inflation shocks.
Well, the chairman did say again yesterday that if inflation did seem to be persistent, the Fed wouldn't hesitate to act and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you'd like, and possibly causing disruption in the economy. So you don't want to be in that situation. I think the risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
There are a lot of people who look at what the Fed is doing and say the economy is opening very fast, as Jim Bullard says. So why do we need $120 billion a month, $40 billion of that in mortgage bonds? What do we get for that we wouldn't get for less?
Yeah, I think it's a good question. You know, we took this policy decision in March and April of 2020. That was a very different situation. The pandemic was just getting going, and it looked like there could be a financial crisis. People were talking Great Depression. So that was the context in which this decision was made. But now you're in a very different situation 15 months later, where the pandemic's coming under very sharp control here. You've got growth in real GDP projected to be 7% in the U.S. this year, faster than China has typically grown in recent years. You've got bottlenecks and shortages everywhere. So this is a very different situation. Treasury market functioning and other financial markets seem to be functioning very well. Financial stress indexes are back down to normal and have been for some time. So I think we're in a situation where we can taper, and I think setting those parameters the right way. We don't want to jar markets or anything, but I think it is time to end these emergency measures.
Well, there's certainly a lot of concern out there on Wall Street that the Fed has sort of eliminated price discovery, and the uncertainty over when you're going to taper is setting the stage for possible market accidents. Are you worried about assets?
I mean, I love price discovery just as much as the next person. I'm a little skeptical that there isn't any on Wall Street. It's true that monetary policy is part of the equilibrium, so traders have to factor that in. I know it's a tough job. But I think we've come a long way with our transparency and our ideas about constantly communicating and trying to do our best to inform markets about where the monetary policy debate is and where it's likely to go, at least short term. But we don't know how the data is going to come in any better than anyone else. And for that reason, you are going to get slight adjustments all the time.
I'm out here in Idaho at the Rocky Mountain Economic Summit with a lot of CEOs and economists, and the CEOs are all asking the economists, why does the Fed think there's no inflation when gas prices are way up, when home prices are way up? Now, I know that raising interest rates isn't going to bring down gasoline prices, but how do you keep inflation expectations anchored when the real economy inflation is something that people are starting to talk about?
Yeah, this is, like I said in my opening comments, this is a different situation than we've seen in the U.S. For quite a while. This is quite a bit of inflation, more than we're used to, and you kind of have a generation that hasn't seen very much inflation. So I do think it will be a challenge to keep inflation expectations in check. I do take some solace that markets seem to be giving us a vote of confidence based on the tips market, that we're going to bring this under control and continue to have good inflation outcomes for the U.S. But it does require management, and it does require us to move appropriately on issues like tapering asset purchases and talking about when we would lift off of zero at some point down the road.
I'm wondering how you think about and factor COVID into your economic projections now, especially since Missouri seems to be the poster boy state for not getting vaccinated and having cases rise.
We track it every day. I like to look at the main indicator, deaths per day per million in the U.S. and compared to other countries around the world. It has come down dramatically and is projected to continue to fall. It's true not everyone is vaccinated. I think that it would be unrealistic to think every single person is going to get vaccinated. That's not how this works. But I'm hopeful that we can get to a level that will bring the virus under clear control. I think that is happening. I also would encourage people to think about the vaccination. I think this is a preventable disease at this point. There's no reason that really now that we have to have very many deaths from COVID-19.
One last question. I want to go back to something John Ferro said at the beginning of the show, quoting a congressman. In the summary of economic projections, you see long-term economic growth at 1.8%. If we're spending all this money, why are we only getting 1.8% growth? What's the benefit to the real economy from everything that you're doing over the longer run?
You know, that is a great question to ask. I think what we're looking at here is really fantastic growth in the U.S. during 2021. 7% is the current projection of various prognosticators and our own staff here. And then I think above trend growth in 2022, above trend growth in 2023. So you've got a period here where GDP is passing the previous pre-pandemic peak in total output produced in the U.S. economy. That's happening right now as I'm speaking. And then it is projected to go above the previous trend line. So you're really looking at quite a strong U.S. economy over the next couple of years. And I would hope that some of that would feed through to the underlying growth rate. I'm hopeful that we'll see productivity growth switch now to a higher growth regime, a higher productivity growth regime, because we have experimented with new ways of doing business, new technologies, and some of that will get into basic processes in the U.S. and lead to faster productivity growth. So that, a lot of that seems to be happening. The data is very volatile right now, but I'd be hopeful that the medium-term growth rate for the U.S. economy would be somewhat higher.
Well, we'll hope you are correct. Jim Bullard is president of the Federal Reserve Bank of St. Louis. Thank you for joining us this morning on Bloomberg TV and radio. I'll send it back to you guys, and I'll enjoy being out here.
You do that, Mike. You do that. Don't rub it in at all. Mike, great work, as always. Michael McKee there with the St. Louis Fed president, Jim Bullard. I think that was a classic Mike McKee clinic on some of the issues, Tom, and a question that he has cited repeatedly, and I think it's really, really important. He keeps asking this. What do we get for $120 billion a month that we would not get for less, Tom? What is it?
Well, we're making it up as we go, and I think James Bullard has been way out front with his interesting theory of a number of years ago on regime change.
And I think the St. Louis Fed president answered it pretty well. Give you an idea of the debate that's going to take place over on the FOMC in the coming months. From New York City this morning, good morning, on radio, on TV, for our audience worldwide, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. Fed Reserve Chair Jerome Powell says it's too early to scale back the Fed's aggressive support for the economy. He told the House Financial Services Committee the debate over bond buying will continue at the central bank's upcoming meetings. Meanwhile, Powell said that inflation has risen faster than expected. He's back on Capitol Hill today. Senate Democrats have found a way to help pay for their $3.5 trillion tax and spending legislation. Bloomberg's learned that they want to impose tariffs on carbon-intensive imports. The plan also includes expanding tax credits for renewable energy and electric vehicles. In China, economic growth steadied in the second quarter. GDP expanded 7.9% from a year earlier. That's down from more than 18% in the first quarter. Of course, that number was skewed by the pandemic. Retail spending and industrial output both beat estimates last month. In South Africa, the number of soldiers deployed to put down riots will go from 5,000 to 25,000. Protests erupted July the 10th after former President Jacob Zuma was jailed in connection with a corruption case. At least 72 people have been killed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Inflation has increased notably and will likely remain elevated in coming months before moderating. Inflation is being temporarily boosted by base effects as the sharp pandemic-related price increases from last spring drop out of the 12-month calculation.
Fed Chair Jay Powell in front of the House Financial Services Committee. He'll face down the Senate Banking Committee a little bit later this morning. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Your equity market looks like this on the S&P 500. A decline, negative, red on the screen. 43.50. We're down 17. We're off by 0.4%. Yields are in, Tom, by a basis point or two. 1.33% as the St. Louis Fed's president makes his bid to start winding down QE.
Interesting market, to say the least, and we'll see this through the Powell testimony today as well. Right now, as we look at bank earnings, we shift to the view of technology. This will be later in the month. Let's call it 1 week on and down on as well. And it is a decidedly different view. Anand Srinivasan joins us right now with Bloomberg Intelligence. He is fabulous on technology, his work at Lazard and Merrill over the years as well. Anand, all you got to look at the base effect revenue growth, just 4 numbers to pick out here of 4 stocks. Up 15.3%, up 21%, up 41%, up 18% as well. Is the tech juggernaut about revenue or is it about profit?
I think it's a little bit of both. I think one of the things that the pandemic has shown is that tech companies have the capability to dramatically accelerate sales. But one of the things that the pandemic has also shown is costs have been wobbly. In some cases, those costs have been able to be passed on to customers through pricing power, and margins have been stable. Some have even seen stronger margins. And in other situations, I think now that the pandemic, most of the pandemic's effect is over, and inflation is kicking in, we will see if this high level of margins can be sustained. I think sales growth, I think, will still be pretty strong. But with respect to margins, that's the key metric that we are looking at going forward. A lot of component prices are going up in hardware. And on software, talent has become hard. And there's been other logistics costs to face. So the question is, will corporate IT particularly be able to sustain this higher pricing that technology companies are going to pass through?
The executives, the C-class officers of these technology juggernauts, and I'm talking about the FANGs and the big companies as well, do they look at this as new territory, or do they feel they've been through this before where they can pass on price increases?
I think that so that's a fantastic question. I think that the pandemic, in a lot of ways, we've heard this from a lot of companies, where the effects of maybe 2 or 3 years of moving to the cloud, seismic technology changes, distributed workforce, central repositories for storage and compute, all of those things that we could have expected over sort of a 3-year period has happened in a 12 to 18-month period. And so companies are dramatically reevaluating where they want to spend money and how they want to spend money. So, so to answer your question, I think pricing power is here to stay, but it is a new dimension in some areas. But the accelerated move is something that the companies are going to have to deal with.
And perhaps nobody has pricing power like Taiwan Semiconductor Manufacturing Company, which came out with earnings overnight. I think this might be actually one of the most important stories that went under the radar in the past 24 hours, highlighting the fact that the chip shortage that we keep talking about that's affected so many industries is set to persist at least till the end of this year, if not into next year. How does this affect industries ranging from automakers to the big tech names that we've seen persistently struggling against this shortage?
Yeah, so that's a great question, Lisa. Look, I mean, the short answer is everybody's get in line, right? Everybody's going to have to pay higher prices, and that is going to be noticeable in the downstream components and products that we buy. Industrial and autos are going to see longer delays because they're not as big pieces of the pie for the semiconductor food chain in general. And big areas such as computing, both PCs and servers, and mobile, which are each call it 30-35% of the semiconductor market, are going to be prioritized. But again, there'll be haves and have-nots. If you're Apple, Dell, HPQ, HPE, you're in a better position relative to a smaller handset vendor or a smaller PC maker. The auto industry is particularly interesting. It's good that you brought that up because the auto industry is roughly about 10% of semiconductor consumption. And it's not a overly profitable market, but it's a strenuous market. It requires extensive testing, long lead times. It's a more difficult market to satisfy from a quality perspective relative to all the other markets. So I think the delays there are to some degree self-inflicted, but also part and parcel of just the nature of the auto industry. I think industrials is probably the most impacted from a chip shortage perspective, but smartphones, PCs, servers, I think you'll get product. It'll cost a lot more. You may not get exactly what you need. You may not get as much as what you need, but you'll get product. And depending on the size of the company and the importance of your company to the overall industry, you'll be able to satiate most of your demand.
Anand, good to hear from you, as always. Anand Srinivasan there, Bloomberg Intelligence Senior Analyst on so many important issues. And Lisa, it will take time to work out.
And in the meantime, prices are going up. That's what I heard from him on everything across the board. Perhaps that iPhone, the extra one, the 15th that Tom is buying, is going to be a little bit more expensive.
You're going to line up for that, Tom?
I don't know. I'm just fascinated by the tech juggernaut. I mean, I just don't know what else to say.
Chanel iPhone. That ticks some boxes for you, wouldn't it?
They're going to be new iPhones, and I don't know yet if they're going to be a regime change.
Michael Ferrari, JP Morgan, chief U.S. economist, joining us in a couple of minutes' time. Jobless claims in America, 350,000 is the estimate, down from 373. We hope it moves in that direction. Your equity market down about 1/3%. Yields are in 2 basis points, 132.40 on 10s. Heard on radio, seen on TV. This is Bloomberg Surveillance. Live from New York City for our audience worldwide on TV and radio, alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Waiting for some data in America as we await that. Equity futures a little bit softer, lower, down 1/3% on the S&P, 43.52. Your jobless claims data is out with those numbers. Here's Michael McKee.
Well, good morning, John. I'll give you the jobless claims numbers very quickly here. 360,000. That's a little bit more than had been anticipated, but it still shows progress along the way. The number I'm going to highlight here this morning, though, is something I really have never done before, and that is the Empire Manufacturing Index, which covers the New York area, shoots up 26 points to a new record of 43. New orders and shipments surge, and the prices received index goes up to 43 as well, which is another new record. So a very rapid expansion in the New York area. In the Philadelphia area, we see a bit of a decline in the Philly Fed index to 21.9, down from 30.7. So it may be a state-by-state thing, but as the economies reopen, we're seeing a lot more of this. Continuing claims at this point, 3,241,000, and the import price index goes up 1%. The forecast was for 1.1%. So there is some inflation out there in a couple of these indicators, as Jim Bullard said, and there is also, at least in the Empire Index, very rapid growth in New York.
Michael McKee, thank you so much. Look forward to your conversation with Charles Evans later today. We'll have that out on different Bloomberg digital products. Right now, really looking forward to this. Michael Ferroli with us with J.P. Morgan, their chief U.S. economist. And usually we can talk about his arch call on potential GDP, a very tepid number, even under 2%, or the other economics of his acclaimed weekly prospect. But today, we go to the gossip of the moment. Michael Ferroli, how does a pro like you look at the gossip of a blended inflation worry versus pros like you looking at, say, the Cleveland median, the Trim Dallas? Which one is right? A blended view of inflation or a more median view, a more acute view of price change?
Well, I think if we're thinking about longer run, the median is probably a better indication of how much transitory influences there are. I think looking at the top line is perfectly adequate for understanding the pressures on household incomes and disposable incomes that are being exerted by these inflation pressures. So they're real. They are depressing the amount of real consumer spending that's occurring in the second and third quarters. But if we want to understand inflation developments out, 3 to 6 months from now, I think things like the median are useful in telling us how much of that increase is being driven by a few categories. And recently it has been driven by a few categories. So we, like the market, the inflation market, believe that as we look out 1 to 2 years, a lot of this kind of spasm of inflation we've seen over the past few months will be out of the picture.
How does Chairman Powell fight off the inflationistas?
Well, you saw a lot of that yesterday. He's persisting in his message that this is transitory. If inflation expectations were to rise in the market-based measures, then you can, a little tough talk, can beat back down those measures of inflation expectations. So far, that hasn't happened, and so right now it's really just a rhetorical tangle with some members of Congress that probably won't have a lot of influence on how they set policy.
Michael, from your perspective, is the flattening yield curve signaling a likely Fed policy error, or is it signaling that this is bad inflation that will, by nature, slow future growth?
I think there's a little of both. Certainly, far forward inflation expectation component of the longer-term yield curve isn't signaling much of an overshoot of inflation relative to the Fed's 2% target. I think the other interesting thing, though, is if you look out at forward interest rates, is that the real interest rate component further out in the yield curve remains very low, in some cases in negative territory. I think that sends a signal that the market doesn't have a lot of faith that this boomy growth we're seeing this year and probably next year is translating into a higher path of trend growth. So I think it's sending somewhat a message really that secular stagnation while it's temporarily sort of out of the picture, will come back in, in 3, 4, 5 years' time from now.
So the inflationistas, as Tom calls them, have pointed to the trend line, that the 3-month rolling average of inflation has surged to levels that we have not seen for 4 decades. How do you push back against that and say, look, we still are seeing base effects, this still is really just a transitory move? Well,
you can control for the base effects by looking at 3 or 6 month annualized measures, and those are very, very strong. You can then also strip out categories that have been, outsized in their influence. Used cars being the obvious one. Some of the, travel and tourism things are normalizations. When you strip those out, it's a little firm on a sequential basis, which is, probably a good thing. But again, if you look at things like the median or the trim mean, it sends a much more reassuring message that, this is narrowly based. Now, that doesn't mean that people don't, to Powell's point, I'm sure he's going to have to say it again this morning, is that it's not that people don't spend money on used cars and gas and airfares. It's just that when we try and think about inflation developments, as we get into the winter and on into next year, should we expect this to persist? And if not, then reacting to it now doesn't make much sense from the Fed's point of view. But it is, look, it's a real hit to consumers' purchasing power, and there's no ifs, ands, or buts about that.
Mike, let's set the scene. We're in a hotel bar yesterday afternoon. I'm with Mr. Tom Keene here in New York City. He's there pontificating about, guess what, inflation. And I see the rack of newspapers, the stack of newspapers piled up in the hotel. Front page, Tom, what did I point to? The New York Post. The front page of the New York Post, and it said the incredible shrinking dollar. And I do wonder, from a consumer's perspective right now, when they're confronted with that, Mike, every time we have an inflation print, they're not reading your research, they're not listening to me. The majority of this country is seeing headlines like that one. What does that mean for expectations?
Well, I think it weighs on expectations, actually, and there's a lot of solid research that shows that higher inflation expectations actually make consumers spend less, which is contrary to economic theory. I would say the more comforting thing is that so far, surveys of consumers' inflation expectations beyond the 1-year horizon have basically just returned to levels they were prior to the pandemic. So, longer run, even the, man on the street apparently has not really changed their longer run view of how inflation developments are likely to play out. And so that should matter for, thinking about price setting and wage setting and wage demands. So far, it's not really. Consumers are understanding, apparently, that just as the market and professional forecasters apparently are also understanding that what happens this year is not a strong signal of what we should expect next year or the year beyond.
At that point, Mike, I think is so important, and Tom, weigh in on this. The discussion that we have every single day on these dynamics are just not the discussions that I don't think the rest of this country are having. And I think that expectations component is something we've got to be laser focused on through the next several months.
The expectations component is out of control. You see it everywhere. I love what Michael McKeejohn said about the Empire Index out of Buffalo, New York. It's not an Elite 3 zip code series. It's something that really talks about a regional pulse.
Well, he talked about policy too, so let's build on that, Mike. Just to wrap things up, for the Federal Reserve, Mike McKee asked this question, and he repeatedly asks it. What do we get for $120 billion every single month, and can we get the same thing for less? What would your answer be to that, Mike?
Well, if we get there, if we go less sooner than the market expects, I think what we would get is a tightening of financial conditions. I think you see that the way the market is completely attuned to every word Powell said. So is $120 billion the right number? No, they kind of arrived at it by accident last summer, or by experiment, let's say. So that might not be the right number, but if they were to dial that back to 119 tomorrow, you can be quite assured that the market would react in a very negative way for financial conditions that affect households and businesses across the country.
Mike Ferroli of JP Morgan. Mike, always good to see you. Thank you. Michael Ferroli of JP Morgan, the chief U.S. economist. And to go back to what Jim Bullard of the St. Louis Fed actually said, Tom. He talked about the crisis, talked about the context for that original decision and how long that crisis would last. They didn't know. The crisis, as far as he's concerned, is over.
Yeah, there's no question about it, John. We got to do a surveillance correction, though, there, John. You know, the New York Post article yesterday was really something stark black. The dollar bill, the shrinking dollar bill as well. You can buy your New York Post at your local McDonald's.
Can you?
Do that? Yes.
Is that where you're suggesting that we were?
That's where we saw it yesterday.
That's where we saw it.
Having breakfast at our local McDonald's.
I'll go with that story.
Thank you. We'll continue with that.
Chairman Powell in front of the Senate Banking Committee in around about an hour's time, Lisa. Same as yesterday? Same story, same message, same script?
Well, how much do they press him on that question that you just raised? What are they getting for their money? And you do have to wonder, what is the harm if you disrupt financial conditions from all-time highs, given some of the record highs and the longest streak of record highs going back to 1997 earlier this month? Maybe that's not a bad thing. And I wonder how much he'll respond to that, why it's important to keep valuations where they are, John.
Those questions will keep coming. What I thought was interesting yesterday, just in terms of the second term, just to have some Republican congressmen say, we endorse your second term. I think that's pretty interesting, given this is a different Chairman Powell to the one that we had in the last 4 years, Lisa. I think that's fair to say.
But he was appointed by President Trump. So, you know, perhaps it's actually a continuation of the old regime.
But it's now a Fed chair with somewhat of a social warrior stance, self-proclaimed for that matter too.
Nobody wants higher rates. And I think this really goes to the point that HSBC's Stephen Major has been making, which is this country at this point can't afford much higher
I would suggest James Dimon wants higher rates.
You think so, Tom?
I would suggest so. Also, Mr. Moynihan and others.
Are you suggesting that might be why the bankers are always talking about higher interest rates? And would that be related to a comment that you made
think it would
a little bit earlier in the show?
Related.
Maybe. I thought so. Tom Keene, Lisa Abramowicz, Jonathan Ferro. Up later, Krishna Mamani of Lafayette College, the CIO. From New York City this morning, good morning. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. A little more than a week before the Summer Olympics begin in Tokyo, the host city recorded a 6-month high in coronavirus cases. People in their 20s and 30s accounted for most of the new infections. The head of the International Olympics says measures against the virus are in place and are working. President Biden has refused to lift travel rules that prevent most Europeans from traveling to the U.S. European governments are growing increasingly frustrated. They cite inconsistent rules, economic costs, and an outdated strategy for stopping the coronavirus. The travel ban is likely to come up today when the president meets with Germany's Chancellor Angela Merkel. Now, South Korea seeks to move up its spot in the global space race. The country's science minister says this means launching satellites on homegrown rockets and eventually a mission to the moon.
The reason for moon exploration is because we expect it to be utilized in the future for not only national defense and the public sector, but the economic sector as well. In that sense, we believe we have to actively take part in the Artemis program in order for such cooperation to take place smoothly.
South Korea saw limits removed on its rocket development earlier this year when the U.S. lifted restrictions in a bilateral agreement. Microsoft CEO Satya Nadella says the company is on the right side of history in antitrust battles. Prosecutors and lawmakers have looked into whether big tech companies abuse user privacy and squash competition. Nadella told Bloomberg TV that Microsoft makes sure user privacy and internet safety are among its highest priorities. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
James Bullard of the St. Louis Fed, a spirited conversation with our Michael McKee leading up to Chairman Powell. Michael McKee talking to Charles Evans of Chicago later today. He at the Rocky Mountain Summit. That's about 23 miles, 30 miles southwest of Jackson Hole. Sort of a preview to Jackson Hole, if you will. This is a joy. There are so many negative stories about asset management. Woe is me, this and that and the other, that it's nice to talk about a huge success own a piece of the rock, and you know it well from Prudential, their iconic effort across American finance since 1875. And out of that has become PGIM, P-G-I-M. Eric Schatzker here with a spirited conversation with a CEO taking a victory lap at PGIM. Right, Eric?
Tom, absolutely. And that CEO is David Hunt. David, it's always a delight to have you with us on Bloomberg Television and Bloomberg Radio. Good morning.
Good morning to you, Eric. It's great to be back with you.
David, we heard it from Jay Powell himself, and no doubt he'll say the same again today. Too early to pull back on monetary stimulus. Let's translate what that means for investors, for financial markets, as someone who speaks for $1.5 trillion. David, is now still a good time to be taking risk, or is now a time to get cautious?
Well, first, a few comments on the chairman's remarks yesterday, and I do think he'll say exactly the same thing today. Without any doubt, the place to look is the labor market. There is all this noise about the monthly CPI indices that come out. I would encourage your viewers not to spend a lot of time on that. All of the action is around the labor market. And that's what you need to do to understand the direction of the Fed and to understand inflation. So in the direction of the Fed, what's very clear, and they've been very consistent on this, is that until we have a lot more job creation in this country and we see unemployment going back down, they are not going to move on rates. So watching that growth of jobs is the most important place to focus. And then secondly is how the actual employment marketplace works. It's too early to tell, but it will be very interesting to see whether or not we do get a rise in wages because it's hard to lure workers back, or will we see that actually employers have made significant advancements, they don't need as many workers, and actually the rise of automation is going to keep wages down. Both of those, I think, are plausible at this point, but we're watching very carefully to see which one. Because what we do know is that if we're going to go back to higher long-term inflation, those wages will need to rise. We've never seen it happen without that. Our view at the moment is that the inflation levels are transitory. We agree with the Fed, and we think their stance is very appropriate given the stage of the economic recovery.
David, the debate over the timing of a taper is intensifying inside the central bank. St. Louis Fed President Jim Bullard told Mike McKee right here this morning, it's time to end these emergency measures. How soon do you think the Fed should slow its bond purchases from $120 billion a month?
So that goes back to what I'm watching closely. That will depend very much, I think, on the employment picture and how quickly that picks up. If we have very strong job numbers and we begin to see wages beginning to rise, then I think we could easily enter into talks starting in Jackson Hole, and then actually the fourth quarter here beginning to be some kind of tapering. If, however, those employment numbers are much weaker than I've just projected, then I think we're looking at 2022 before that begins to happen. But I think that labor picture is the piece to focus on to really understand where they're going to come out.
David, when you look at the S&P 500 up almost 17% year to date as a proxy for risk assets, and the Shiller PE ratio pushing higher and higher, now at 38 times. What signal are those indicators, let's call them, sending to the asset allocators who are your clients?
So the dominant fact of the investment landscape today is that it's never been more punitive to hold cash. Full stop. For the last 24 months, that's been true, certainly in the United States, but even more true actually around the world. And what that's doing is driving unprecedented amounts of money out of government bonds and into higher risk assets. Certainly including equities, but also including a wide range of other alternative assets where we see the search for yield just intensify. So I think what you have to believe about valuations today is that those are supported by a view that rates are going to stay low for longer. That's a view that we certainly have, but others have been pushing back hard against that, and time will tell.
Well, let me go back to my first question then. You speak for $1.5 trillion. Is it time to be taking risk or time to get cautious? It sounds to me like you're on the risk-taking side.
Full stop. We believe that risk assets are attractive today, and we certainly are constructive on risks. We're mindful of some places where pricing has run ahead, but broadly, there's plenty of risks in the economy. But our base case is for the next 18 months to have very strong economic recovery and economic performance right across the developed world, and including China.
David, you and I have talked many times about the need for consolidation in asset management. Earlier this week, PGIM announced a small purchase, a Swiss private equity secondaries firm called Montana Capital. Is that the extent of the deal-making we'll see from you, small bolt-ons?
So let me put this a little bit in perspective in terms of our broader alternative strategy here. So we manage about $250 billion in alternatives across both public and private. We're the third largest alternatives firm in the world. Mostly for us, that's been a very leading real estate business and a private credit business. But we've been seeing a lot of money going into alternatives over the last 4 or 5 years, and we've been working closely with our clients on their alternative strategies. One thing that's become very clear from their perspective is that they feel that they need more liquidity for their private equity portfolios, and increasingly now for real estate and private credit. And what secondaries do is allow them to actually swap out their LP interests. Mm-hmm. So this is bringing liquidity to the private equity industry. And that is, we see a very kind of early stages, but rapid demand in that. And so we are delighted to welcome Montana Capital Partners to the PGIM family. It's a very high-class firm that's been around for a decade and has a terrific investment capability. And we believe that they're going to be really critical to meeting the needs our clients have for finding more ways to provide liquidity into their private equity portfolios.
David, why just secondaries? Right? The money is pouring into buyouts. Look at Hellman and Friedman. They raised $24 billion for a single fund. That's news out today. Why isn't PGIM participating in primary private equity?
So, Eric, we certainly have spent time looking at that, but in truth, we don't see what we bring that is special to that particular area. The world does not need another KKR. What we think we bring is a unique investment capability and an institutionalized capability in secondaries, now with Montana, where we can actually build a fundamentally differentiated franchise. So I applaud the leaders in private equity. I think that they've done a wonderful job. And as you and I've talked about before, I think that's going to continue to grow. But for us, we wanted to have a distinctive capability where we could actually build an institutionalized investment process that would directly speak to what our clients need today.
David, one last quick question for you. I can't help but notice the enormous ESG business you're building inside PGIM. It comes with some risks, I might say. How big a problem, David, is greenwashing in sustainable investing?
I think, Eric, it's a major problem. There is so much kind of marketing spin around ESG now that sometimes it's hard to separate the wheat from the chaff. And I think that the big question that I would encourage all of your viewers to ask their asset managers is, to what extent is ESG fundamentally grounded in your investment process? So it can't be a screen. It can't be a separate overlay. It needs to be part of how you manage money on a day-to-day basis. So every bond that we own has an ESG rating on it. Every stock we own in our quant portfolios has an ESG rating. And we use that both to make sure we're fulfilling our fiduciary duty to clients and considering those risks, and to then offer products that allow our clients to express how they want to invest in ESG. But if you don't start with that foundation of a true integration into your investment process, then you're really just on a marketing campaign. And that's the thing to look for.
David, I want to thank you very much for spending time here with me and the rest of us at Bloomberg Television and Radio. David Hunt, is the CEO of PGIM, Tom.
Eric, thank you so much. Eric Schatzker there with an important interview, a successful story in asset management. We're going to drive forward here with the futures red, NASDAQ green again. Sorry, Lisa. Eric started talking. Schatzker lifted the market. That's all there is to it.
Single-handedly, break exclusive. I think that, again, the action in the bond market really telling after that New York Empire manufacturing data coming out. The hottest ever on record. Fascinating.
Lisa, John's off the set, so you and I can talk about Bitcoin.
All right.
It's a little fragile here. Bitcoin under 32,000.
I'm not going to weigh in on Bitcoin, but did you see yesterday that the founder of Dogecoin, which is basically a joke coin, he came out and basically slammed all of crypto assets in general, saying that it was basically wealthy individuals enriching themselves. Just to give you a sense.
We'll listen for Chairman Powell this morning to see if he's gone along on the Doge.
Definitely.
Well, it's an important interview, the symbolism of Angela Merkel visiting the White House. And President Biden, I believe in the 4 o'clock hour this afternoon, they will have a joint appearance. We will do better on Balance of Power at 12 noon. We are thrilled to bring you the former ambassador of Germany to the United States. Ambassador Issenger will join us. Really looking forward to that. Please stay with us through the day. Chairman Powell coming up on Bloomberg Radio, on Bloomberg Television. Good morning.